there are too many problems that investors have to overcome in the first half of this year.
Now we're starting to see more dispersion in the data, in the economic outcomes.
It's going to be a harder environment to see fiscal and monetary response, and we think that leads us to an equity market that can have some healthy declines this year.
I think we are very much revisiting the more normal dynamics now.
The story this year is the earnings risk and the recession risk, not the inflation risk anymore.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Equity futures up 0.1% on the S&P. You look fantastic.
Thank you.
You look brilliant. My tie fixed as well. Let's talk about these job cuts at Google, Tom. Alphabet, 12,000 jobs to go, 6% of the workforce. They join a pretty ugly club right now.
No surprise there, and the number 6% is key. I would suggest window dressing the end of the year into a new year. 2 to 4% is sort of the way all industries go. Clear out the deadwood. This is more than that, again, 6%.
It goes way beyond that, Tom. I think tech, and I said this a little bit earlier this morning, appearing to be going through its very own post-GFC moment for this industry, Tom. Years of excess. The good times aren't coming back anytime soon. And the austerity, it feels like, TK, is just beginning.
I can't say enough about how you're right on this, and it is a cultural moment for Silicon Valley. I'm going to go, and we make jokes about it, but this is not funny. Google used to hold court at the piano bar. Dave Drummond, their general counsel, Mr. Brin, and the others, and there was that Silicon Valley tone that permeated Davos, Switzerland. It's gone, finally.
They're throwing money. They had money thrown at them, Tom.
Fitbit. Oh, please, where's my Fitbit?
What about Fitbit?
Oh,
what about it?
I wore it for 3 days. They bought Fitbit. That was one of their acquisitions to save the world. And, you know, I read a lengthy article, Vox, with a spectacular article on Amazon. Same thing, John. They just buy this, innovate. It's over.
The discipline of 4%, Tom. 4% rates, the discipline of 4% rates, 450 at the Fed and maybe 5, starts to bite.
Yeah, it's that, but it's also in the short rate market where finally money costs something. And I'm sorry, Google puts their pants on one leg at a time. And with the new cost of money, they, like Bed Bath & Beyond, are adapting and adjusting.
Well, let's talk about the cost of money right now. So this came from Vice Chair Brainerd yesterday. These words,
you mentioned this.
We are determined to stay the course. These words from President Lagarde a little bit earlier this morning, Tom. Stay the course is my mantra for policy. They want to stay the course. Can they stay the course?
Yeah, but you did this brilliantly, John. It's really important, folks, that John and I approach this differently. He really, really reads these documents. I'll be honest, rarely do I. And the fact is, go through the Brainerd idea of there was an intro like a good movie, there was an outro to get to the sequel, and in between it was a little different.
The in-between stuff is the more important stuff. So if you open the speech from Vice Chair Brainerd yesterday, at the start of the speech, she talks about staying the course. At the very end of the speech, concluding, you know, we need to stay determined, keep working, all of that good stuff. In the middle of the speech, and Kit Jukes referenced this over at SocGen this morning, thinking out loud about the potential of a soft landing. Reflecting on how much monetary policy tightening is already in the pipeline, Tom, and how much damage could be done in the future. We're shifting towards 25. That's the story of the Federal Reserve. We're shifting towards 25.
We're shifting towards February 1st after some difficult, hard economic data. And the market reaction, let's remember the Dow, I believe, I don't know where SPX is. I never follow it. But the fact is equities have come back from that early January rally.
I can tell you futures right now, just about positive by 1/10% on the S&P. Snapshot of the market, we look a little something like this on a 10-year in America. Your 10-year yield at the moment up 4 basis points to 3.43 on a 2-year, up 4 basis points also to about 4.17 on a 2-year. In the FX market, euro dollar, we're staying the course at the ECB. 108.40, euro dollar positive, 0.1%. Joining us now to kick off the program this Friday morning, and good morning to you, is Brian Weinstein, head of fixed income at Morgan Stanley Investment Management. Brian, there's a subtle change emerging here in the Fed speak. Are you picking up on the same thing?
Yeah, you guys are all over it this morning. I mean, at some point you have to move to 25 because you've done a lot. You don't know how much damage that you've done, but we know inflation numbers will fall. We know that there's some weakness in growth numbers forward and jobless numbers. Not today, but that 6 months from now we'll see weakness there. So you switch to 25. They have a different problem though. Risk assets then price in 200 basis points of immediate easing and go right back up and search for highs. So it's a delicate dance the Fed's trying to do.
Brian, very importantly, and Ben Emmons absolutely nails this morning, and it's the Brian Weinstein world. There's a massive fear of missing out in that in the bond market, issuance is nuts. Explain to our audience why everybody and their uncle is putting out bills, notes, and bonds.
Well, I guess I would say there's at least two interesting factors. One, beginning of the year, I always find the first couple of weeks of January very confusing as an investor looking for signals because people just have capital and they feel like they're missing out and putting it to work. But I do think behind that are yields, income, right? I mean, everyone wants to talk about recession and big corrections and huge moves. What if nothing happens this year? Well, if nothing happens, you get paid almost 5% to put your money into T-bills, right? You can make more if you put your money maybe out the curve and we get more of a rally. So investors aren't crazy. They haven't seen this in a very long time. But when you think about the safer credit markets, whether that's U.S. Treasuries, a different story, but investment grade, municipal bonds, things like that, you actually get paid to buy. And so companies are issuing because we rallied and things feel better. But investors are buying because they get paid to wait.
Is your framework clip the coupon, or can I hope for a Dan Fussian-like total return?
Listen, I like clip the coupon for now. The bond market's, I think, a bit ahead of itself. Again, are we going to get 200 basis points of easing? Is that so certain you can continue to buy 10-year notes at 340? I'm a little skeptical, but longer term, Tom, I listen. I don't know. We're going back to 4.25 where we were towards the highs. So you can get your coupon plus. I think you can be a little careful what you buy when, but if you maybe buy it or sell it, I'd buy it.
There's a bumper sticker. Brian, he's living large. You know how he's done at Morgan Stanley. He's got the Jeep Wagoneer with the wood sides. He puts the kids in the back and all that. He's got a bumper sticker. Coupon plus.
I'm not sure how many other people have that bumper sticker. Brian, I want to come to you on the difference between what you think is going to happen with treasuries and what you think will happen with US credit, corporate credit, high yield credit to be specific. Do you really want to take credit risk here, going into what people think could be a recession, and at a time where spreads are in and around 400 basis points? And I keep saying this, the ISM is sub 50. So you've got spreads that have been tightening at a time where the data has been getting worse. Is that a good time to be buying high yield credit?
I mean, historically, no, right? High yield's been interesting in that it's pricing in a much rosier scenario than some other markets. That said, if you go back to 4.25 on 10-year notes, you were getting close to 9% or a little bit more on high yield. So at that rate, you get paid to make some mistakes, right? You're going to have defaults. It's okay. Back to my previous comment, I don't know you need to chase it here, but I'm not sure you're playing for 2008 where 10-year high yield spreads blow out to new wides. So I'd be a buyer of high yield spreads on weakness if yields went up, if spreads widened. But I think there's a relative cheapness of the more boring sectors. People don't love to chase those sectors, but I think you'll get better opportunities in some riskier sectors.
Brian, what are the boring sectors? What would you call them?
Listen, you've seen the huge amount of money into investment grade, right? A sector that people don't love to talk about, not nearly as sexy, but you get low defaults, you get another 120 basis points over treasuries, a little bit of duration. To Tom's upside comment, you can rally, you can actually make more than your coupon. Municipal bonds got really cheap in October. They still look pretty good now, but places where you've historically had low default rates and better liquidity, I don't know that you have to be super fancy. And I think T-bills, right? Money market funds look great now, given where the curve is.
Brian, this weekend, are you going to worry about the debt limit, the debt ceiling, the default of the United States of America?
No, Tom, I'm not. I mean, I think it's political theater. There's real short-term risk if you're a bill trader. Other than that, I think you put it in the back pocket, realize it shows something about dysfunction of government, but we're not going to default in the U.S.
Should we bottle that sot and just replay it from now until
the summer? I mean, this is where Wall Street's at, Tom. This is the way they see things.
No, but for those of you that aren't sophisticates on this, you see how Mr. Weinstein just, professionally dismisses it, like, move on.
For now, I wonder how much more seriously you'll take this, Brian, when we do start to get towards that X date later in the summer. Do you not get a feeling in any way, shape or form that this could be somewhat different?
Again, yes, we've seen them come real close before, right? We've been downgraded. I forget exactly the year, but we played chicken with the debt ceiling real in a real big way. But again, that a major holder of U.S. Treasuries, or any of us as holders of U.S. Treasuries, should worry about not getting paid back. I don't think that's the number one thing on minds. It will have short-term impacts, as you said, when we get closer to mid-year, but it's not going to be my weekend. My weekend fear is more of the big picture things: recessions, job layoffs. People,
stop it, Brian. Stop it. Giants or Eagles? Which one?
Oh man, I'm a Giants fan. They look great. I hope the Giants win. I think they can do it.
There we go. That's what
Are we starting a sports segment early
We're starting
this morning?
with Brian.
Okay.
You got to start the sports segment.
Hey,
early.
Brian, thank you, buddy. As always, Brian Weinstein there of Morgan Stanley Investment Management. Is this time different? We're going to be asking that a lot through to the summer. I remember an address from the former president, Barack Obama. And I remember at the time that he wanted markets to take it more seriously. I remember there was this address from him, Tom, where he was almost pleading with markets to sell off. My words, not his, and you can reflect on some of the comments at the time around 2011. But, Tom, it felt that way, that it would have been easier for him if markets had reacted in a much more violent way to what was taking place. And the fact of the matter is, in treasuries, that's not how it works for people. We discussed this yesterday. When you get into a dicey moment with the debt ceiling, what do investors start to buy? They go to treasuries.
Yeah,
and when I say is it different this time, I want to understand if that's going to change. And based on someone like Brian, who's in the fixed income market, he's telling you he's not going to shift away anytime soon.
And the FT has Katie Dugat has a beautiful article today summarizing the reverse repo market, the land of Ira Jersey folks, and the idea that when in doubt, do what you just said, John, and also put billions, if not trillions, into the cash in the overnight market. You go hide. And then it's over.
You saw what Bill Dudley said, the former New York Fed president, about the plans they had.
Yeah,
they had to look at this back in 2011, I think again in 2015, and take it seriously. And Tom, they were talking about buying in the secondary market and buying bonds if things really hit the fan. Yeah. Doesn't that kind of encourage it, though, TK, to know that that's there? You've got that backstop.
Yeah, but they have an institutional responsibility to do it like a banana republic. But what I'm really going to listen to is Anne-Marie Horton. And I'm going to listen to Anne-Marie Horton because this time is different after what we saw with the speaker soiree here a number of days ago, and that you've got a certain group. How will they react when you get closer to those important hours at midnight?
We heard McConnell recently,
playing the game.
The Senate Republican leader, Mitch McConnell. He was pretty emphatic and very clear about it. The U.S. will never default. Is he running his party in the way maybe he has run, Tom, in years gone by?
I think Anne-Marie nailed it yesterday. We saw her way too much yesterday, I thought.
I think we're going to see her in a moment.
We are?
Isn't she joining us in a second?
She's off today. Everybody I know is off today. Shonali's off, Anne-Marie's off.
Shonali's off? I didn't know that.
They're all off. You know, you and I are the only ones working in the building.
Is Bramo off, or is she still with us?
Bramo's, I don't know what the Gulfstream's doing.
I heard a rumor she's going to join us at the end of the
program. Sam Moritz, maybe?
Is she going skiing again?
I think she's going skiing again.
I thought the snow in Europe wasn't good this year.
She doesn't care. She just goes and drinks.
That's what I hear.
You know, I don't know.
Oh, she drinks on the piece, like
sure.
the après ski.
Yeah, the very après.
The very après.
She's like out of a Bond movie, you know.
Futures up at 10 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The parent of Google has become the latest tech giant to retrench after years of growth and hiring. Alphabet will cut about 12,000 jobs, more than 6% of its workforce. CEO Sundar Pichai says the cuts will affect jobs across the entire company. Pichai says he takes responsibility for the decisions that led Alphabet to this point. The Biden administration is sending another major package of military hardware to Ukraine. It includes 90 Stryker armored personal carriers, 59 Bradley fighting vehicles, and millions of rounds of ammunition. The package, valued at $2.5 billion. The U.S. and its allies are meeting in Germany today to discuss more aid. In Japan, inflation has hit 4% for the first time in more than 4 decades. That's twice the pace targeted by the Bank of Japan. And it's likely to lead more speculation the central bank will change its monetary policy. And David Crosby is being remembered today as one of the most influential musicians of the classic rock era. Crosby, who co-founded the Byrds and Crosby, Stills, Nash & Young, has died in Los Angeles. He performed for more than 5 decades, and his group sold millions of records. All the while, he battled drug addiction and a number of other ailments. David Crosby was 81. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We will pay our debts. We always have, we always will. How Messi is going to getting from point A to point B, we don't know yet. We're going to target basically the debt and the increasing of the debt to how we can basically prevent that from continuing to increase as it does and start a downward trend. And there has to be some discipline, and there has to be some sacrifice.
Discipline and sacrifice. That was Senator Manchin speaking in Davos, Switzerland, alongside David Weston. Fantastic conversation. You can find that on Bloomberg.com and on the Bloomberg terminal. Equity futures right now. Equity futures are positive by 1/10% on the S&P, trying to erase a weekly loss. Been a pretty ugly week so far, Tom, I've got to say, in the equity market. Yields are higher by 3 or 4 basis points, 342.93, euro dollar 108.35. For all the doom and gloom, let's go back to it. Just revisit it for a moment, Tom. For all the doom and gloom, jobless claims yesterday, 190,000. Does that scream recession?
4-week moving average 206,000.
Unreal.
I believe it is.
Unreal.
I got a VIX at 20.49 that tells me the market's not as ugly as the ugliness that financial media is given. And again, if you're just joining us, Google layoffs this morning. John, this is original, and again, it comes out of a pandemic. I'm going to lean on Professor Summers, Professor L. Arian, Professor this, Professor that.
Yeah.
And the answer is really smart people are thinking as hard as they can about the shift from pandemic COVID over to something that they remember. Who says we're going back to something we remember?
Except you can't shift away from the pandemic too soon.
Yes.
You've got China reopening. And as we've said a few times already this year, this is the third year of pandemic economics complicated by China's reopening. I think this is really difficult. And Tom, what are we going back to? There's not a new normal. It's maybe the old normal of just rates at 4%.
One of the most intelligent.
We stay there for a while.
One of the most intelligent conversations of the week, folks. I believe we'll feature this in the 8 o'clock hour. Was James Gorman with Lisa Abramowicz, and he was heated about work from home. That folds into the labor picture. I'm not sure how, but Gorman was, I thought, brilliant, articulate, and heated, impassioned about where are we going in this new work-from-home society. How does that fold into McKee's Jobs Day? I don't know.
Well, industry to industry, and I think we can talk about the financial sector and we can talk about the tech sector as well. There is a feeling amongst a lot of people that, Tom, things got too soft. They got too soft at many of these corporations. Yeah. They were worried about first-year analysts at the banks. I wonder if that attitude has shifted in a very big way after the last 12 months. And tech, Tom, basically, if you worked at a tech company, you could work wherever you wanted. Now with these kind of job cuts, Tom, it brings discipline and I would say job insecurity back in a way that, James Gorman says get back to work. I think a lot of people will get back to work when they see the job cuts on the street.
Jason Del Rey at Vox, I can't say enough about the journalism here on Amazon. And he describes, John, exactly what you just said, which is he speaks to multiple ex-Amazon senior officers who say the company got soft. That permeates. I'm not sure it permeates every sector. That's unfair. But in tech, I think we can say yes.
Well, Twitter's an example of that. Weren't they selling?
That's a unique
weren't they
story.
empty in the office? Weren't they selling things like the pizza oven and all that good stuff?
I don't think it's appropriate for me to comment on Twitter. I'm afraid I'll get banned like Susan Lee over at Fox Biz. But
what, banned from Twitter?
Yeah, Susan Lee.
I think Susan Lee's back on that.
Our friend Susan Lee, she's back on.
Our friend Susan Lee is back on Twitter.
She went to Davos. She wore Bogner the whole time.
Is that right?
Yeah, and I just think the whole tech thing's in a tumult. A la Bitcoin. Shonali Bassick, I told, was listening to us and maybe in the house here in an hour or so. And the bottom line is Bitcoin this weekend's blown up. And that's part of that tech zaniness right now.
It's years of excess. I've asked this question a few times, so let me ask it again. Is it the last 2-3 years of excess or the last decade of excess?
Oh, no, decade.
That we need to unwind?
Oh, no.
If it's the last decade of excess, okay, so let's talk about Amazon. Amazon going into the pandemic had about 800,000 employees. After the pandemic, that had doubled.
Yeah.
Tom, that had doubled to about 1.6 million. I think it's come down to about 1.5. Okay, so if you look at their job cuts recently, and we're talking about removing excess, have we seen anything close to what you expect to see from a company that's had expansion that large? And that's only the last couple of years. Never mind the last decade.
Speaking of X, should we go to Anne-Marie? Speaking of excess,
we can, sure.
Speaking of excess, Anne-Marie Horton joining us now, our Bloomberg Washington correspondent. Anne-Marie, I want to do a Friday take here to get to the Sunday talk shows, many of which you can hear on Bloomberg Radio. Anne-Marie, it's real simple. Where's the Biden reset? 2 years into an administration, every administration known to mankind, back to GW, resets. Where's the Biden administrative reset?
Well, if you're talking about a reset in terms of personnel, because usually you do see people leaving midway through an administration, which is 4 years, It's not happening for the sense of, I think, two reasons why. One is a lot of these foreign policy folks are still deep in the trenches of dealing with ongoing crisis, right?
Okay.
In terms of Russia's invasion of Ukraine. The other is that this is just a Biden aura, right? He does not get rid of staff. A lot of these people worked with him when he was in the Senate and when he was vice president and now is president. So you don't see him firing people, and it's hard for people to leave. I mean, that's really the truth.
This is the critical question then, and this is something, folks, over my entire effort here at Bloomberg, every administration has a cadence of debate. Obviously, with the former President Trump, it was truly unique. What is the day-to-day method and process of debate, Anne-Marie, in that White House you're standing behind on the lawn?
Well, I think the cadence of that has changed, right? They've lost the House now. So it's gridlock on Capitol Hill, and there's only a few things they can really focus on and get through. I would say that the start of their year, while it was going well, has been completely overshadowed by the documents that were found in the president's former office after he was vice president, as well as his garage in Wilmington, Delaware. That has really overshadowed and created a lot of headaches for the administration. But obviously, with a divided Congress, they cannot push for the legislation and the debates that they had wanted to have and the ones that they did have the prior 2 years.
MH, what is happening with that? What's the next steps in that investigation, if there is one?
Well, we're just waiting for the special counsel, right? There's two special counsels now for one president, one former president when it comes to documents. The President Biden talked about this yesterday, though. He said he has no regrets on how it was handled because what he says is that documents were found, lawyers were brought in, they were alerted to the National Archives and alerted to the Department of Justice. He's really trying to paint this picture with how we handle these documents versus how the former president, Donald Trump, handled these documents. But obviously, there's a lot of criticism and questions about the timeline of this, about why was there only a public statement after there was a CBS report, and tons of other questions. But the president yesterday said there's no regrets, but this is something the media will continuously focus on and ask him questions about. But really, the answers we're going to be looking for, we're not going to get until, the special prosecutor wraps up the investigation.
The timeline is odd, isn't it? Can you run us through that? So he left the administration, the Obama administration, seemingly went away with some of these documents and then ended up at Penn with the same documents. How does that work?
It's a great question. These documents, similar for the former president, these documents are the property of the U.S. government. It does seem like when boxes were packed, in both instances, in one, there was a lot more in terms of volume of documents as opposed to President Biden's. But these documents ended up in private residences as they packed up their offices. And the timeline, Jonathan, 6 years in terms of Biden's documents, right? Because this is when he left the Obama administration. They were, though, these documents, in terms of volume, a little bit less, but the timeline of them is interesting because, and this is what the press continuously asked the administration, they found these documents before the midterm elections. So Republicans obviously are going after the administration for hiding this, saying that this could have impacted the outcome of the midterm election. Biden administration says we were going with protocol, which is what we did.
Anne-Marie, thank you. Down in Washington, D.C., I imagine this story, Tom, is not going away anytime soon.
Yeah, well, it's there. I mean,
Sure.
it's a little bit off our radar of what we do here at Bloomberg Surveillance, but at the same time, can we learn what the documents are without giving away the secrets? That would help, I think, the debate for all involved.
No idea. I just wonder how this keeps happening. How does this keep happening?
I asked...
Can't make sense.
I asked... Did it happen before, but nobody noticed that President Ferro in 1953
Not sure anyone wants that.
had a classified document by the telly as he was watching Man U win 4 in a row?
I wasn't born here, so that can't happen.
Okay.
Could happen for you, though, Tom.
It could have happened for me.
Could happen for you.
Zachary Taylor, I think, had a classified document.
Friday morning, good morning to you. Equity futures positive about 0.1% on the S&P. Just a little bit of a shift higher. Equity futures grinded higher by 0.4% on the Nasdaq. We'll touch on Netflix a little bit later. Crushing estimates. Crushing estimates.
Crushing.
I tell you what, Tom, trying to guess these subscriptions. Netflix is like blindfolding yourself and throwing a dart.
I don't.
It's just,
the
guidance seems to be absolutely garbage.
I thought Jessica Reif Erlich yesterday was great.
She was great.
Geetha Raghunathan is the same kind of micro data on this. My major decision is, do I start watching Wednesday this weekend?
What's that?
That's why Netflix is. Come on, John, you're
Wednesday.
so behind.
I've got no
Wednesday
idea what that
is a series, and it's like Addams Family.
Okay.
And it's like everybody at home's vet bill's watching.
I've got no idea. I was watching the football yesterday.
Well, I don't watch
on Peacock. That's another rant.
That's another rant to have.
It's the bond market.
Wednesday.
2s, 10s, and 30s. Look like this on a 10-year at the moment. Yields higher by 4 basis points. 343.29 on a 2-year, up by 4 basis points. 416.39 in foreign exchange. Euro dollar. You saw it from President Lagarde this morning. Stay in the course is my mantra for policy. Echoing Vice Chair Brainerd, we're determined to stay the course. They all want to stay the course. Euro dollar 108.36. We're positive. Not even a 1/10 of 1%, up 0.03%. I think you can say that's unchanged. The Fed's last word before the quiet period begins. Philadelphia Fed President Harker and Governor Christopher Waller set to speak a little bit later today as top officials. You've heard them so far. Lael Brainerd, John Williams, making the case for high rates.
Inflation has declined in recent months, but inflation was very high, and it's going to take time and resolve to get it back to 2%. Policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
That's the punchline, TK. We're going to stay the course to get back to 2%. The body of the speech, though, that we heard from Lael Brainerd there is far more interesting. Just opening up to this idea, Tom, that perhaps it is possible, and I'll use her own words, it is possible that a continued moderation in aggregate demand could facilitate continued easing in the labour market and reduction in inflation without a significant loss of employment. That is what the soft landing is all about.
You didn't see this on radio, but what's important there in the Brainerd speech is where she did it. It was a Chicago Booth School, and of course, Chicago is the land of microeconomic studies. Jeff Curry of Goldman Sachs taught micro at Chicago, which is the height of economic acuity. And what's important there is all of microeconomics is about finding the ambiguities in the debate, and that's what she's addressing with this garbage phrase, soft landing.
That drives you nuts, doesn't it?
Drives me nuts. There's ambiguities out there that we don't know, and people like Brainerd can't get there until they see the data.
Soft landing is just an easy way of saying, can we get inflation down without having unemployment rise too much? That's basically what it's about. Can we get a reduction in inflation, a softening in the labour market without unemployment rising too much? And right now, Tom, unemployment's at 3.5%.
Yeah, my problem on this, we've got to get to our good guest here, but my problem on this, John, is soft landing doesn't describe the socioeconomic structure of 2/3 of America. 2/3 of America in some form is flat on their back right now, including 10,000 plus people at Google. Those people aren't having a soft landing, because there's a group of people, including John Ferro and Tom Keene, who aren't having, we're living at large. And this is this non-aggregate approach to the challenges Vice Chairman Brainerd has.
Dr. Alarian writes in, would you like to know what he says?
I'm afraid
Wednesdays. Daughters love it. I'm like John, got no idea what it is. But daughters love it.
I think, I could see in Cambridge that, they tune in to Wednesday this weekend. I'll do the same thing. And it's very
I don't know if I'm going to watch that, Tom.
I don't.
Do you know what? Maria Tadeo just wrote in as well. The only thing to watch on Netflix, I Am Georgina. That is mom influencer, businesswoman, and Cristiano Ronaldo's partner. If that helps. Does that help? When was the last time you heard from Tadeo? I've not heard from her at all. That's the first message.
Was she at Davos?
I don't know.
She's
probably
they're incognito.
I don't think so.
She's probably outside.
Like just doing that.
She's in the bars and the promenade kind of thing. It would be my guess.
Doing those interviews on the sidelines.
We're going to salvage the show and get you to your weekend thinking and weekend reading about what to do in a multi-asset strategy. And Witty Bangana deals with this each and every day at Columbia Threadneedle. And all my radar's up on Witty because so many people are telling me bonds is the only comfort zone. Is that a consensus call, and does that concern you?
Hi, Tom. Thanks for having me. It is appearing to be a consensus call, and for two reasons, I think it makes a lot of sense. One, the economic data so far, including the one that came out this week on Producer Price Index, is indicating that inflation has peaked. So all of last year was too much inflation, bad for bonds. This year, very simply put, inflation's peaked, yields are likely to peak. And that's what we have witnessed in the last 6 weeks or so, yields coming off pretty sharply. The second point from a multi-asset perspective is that they're once again acting like a hedge. So this week we saw Wednesday massive sell-off in equity space and bonds rallied. So the old ballast question is back on the table again. They are attractive because data is indicating this, and they're acting as a hedge.
Let me go right to multi-asset then. So many of our viewers and listeners are going to say, okay, but I'm pitched by advisors and such, this tranche of fixed income or that. How do you look at the choices to make in fixed income? Is it a duration choice? Is it a credit quality choice? What's the most important factor there?
Both are two levers that bond managers use in trying to beat the index. The fixed income duration is the hedge part right now, because as yields come down, duration rallies, and that provides positive returns. And credit is something that we are quite nervous about right now, because all indications are that we are having, whatever the term might be, a soft landing or some sort of recession this year, and you want to stay in good quality credits. So we are underweight high yield, we are underweight sort of the riskier tranches of credit, and staying in investment grade credit.
What do your equity people say? I mean, Columbia Threadneedle does it all, and I'm interested in the equity prism that you have more focused on multi-asset and fixed income.
Sure, that's a great question. In equities, things are a little more hard to pin down, really, because if we look at the valuation lens on equities, they don't seem to have fully priced in this recession fear that's out there for this year. So in the US space, our managers are staying fairly defensive. They like the good quality components of the US stock markets. But from a multi-asset space, we are seeing attractive opportunities to actually hold emerging market equities, where we have a massive valuation cushion that's built up in the last decade or so. And at the same time, there are improvement in sort of the dollar view and the growth prospects from China. So we from a multi-asset desk are liking emerging market, particularly emerging market Asia. But in the developed market, we're staying high quality.
So we're trying to stagger to Q2. I think there's a huge unknown on Q2. You've been doing this for a few cycles. Are you able to frame out the fourth quarter of this year?
In terms of earnings, you know, the market's doing the standard kabuki it does every earnings seasons. Expectations are brought down pretty sharply, and then they're beaten. And so far, that's all we are seeing in data. And I would say it's early days. Expectations for 4Q is that earnings will be down about 2% or so. And so far, with about 10% or so of earnings that have been released, they're beating those expectations. So we might end up, if this current run rate continues, with, you know, flat earnings to mildly positive. But expectations for the remainder of the year for 2023 are quite bleak. Earnings are supposed to go down.
Thank you so much. Enrique Bagano with us here this morning with Columbia Threadneedle. John, I'm only discovering this, John, on what is it, January 20 today? I can't remember.
What if you worked out?
I'm discovering,
January 20.
Listening to her on January 20, I'm discovering what I should have known December 30.
Which is?
Which is the huge uncertainty of the actual allocation of a retirement plan. I don't think after last year and the blow up, I mean, last year is at least as bad as 1974, and we had one guest, folks, this week allude back to 1788. I don't think anybody, you know, with the good efforts of Bagano, who's world class, anybody has a clue how to allocate after a 60-40 blow up.
I think to your point, Tom, to make up the losses, particularly on the bond side of the portfolio, how long is that going to take? Some of the damage done.
Well, I'm not going to give an opinion here, but guests are telling us 18 months, 2 years, 3 years. I'll go out a little bit farther.
How far would you
further
go?
and far. I don't know.
I'm
I
gonna
don't
whisper
know.
this.
Anybody who says they
It's
know.
very, very presidential when you whisper.
It's just, well, I'm whispering because I'm rich.
That is
in
great.
England,
Have you seen that comedian?
This is
That's
a
fantastic
comedian in England, Jen Bristow, I think, who does
That's
it.
fantastic.
It's absolutely
Isn't she good?
hilarious.
She's fantastic.
She's very good.
Wednesday was fun, Tom Keene, but it was very 2022. You and Ferro should try Kaleidoscope. That from Barry Ritholtz.
If this is, folks, do this. We're having fun with this on a Friday as we get in the weekend. There's some serious tone here to talk about. What's important about this is afterthought applied to Nevermore Academy. I mean, she, you know,
You're going to have to do that. I don't know. What does that
we
mean?
were going to send her away to school. She does such a discipline problem, and she looked at Nevermore Academy along with Choate and the rest of them.
Do you think it stems from the fact that you call your child afterthought?
Yeah, well, maybe, but she's still at home. We have
might be the essence of the problem.
Day-to-day supervision here at home, but you know, it's come on, it's Chittenden, it's in the Woonsocky River. It's sort of southwest of the Wobbly Barn in Killington. John, this is where Wednesday is.
I've got to make this serious for 20 seconds, can I?
Come on.
Netflix is up this morning. The stock's up by 5-6%. The company added 7.66 million subscribers in the final quarter of 22. Guess what the average estimate was on Wall Street? 4.5 million subscribers. It drives me insane, Tom. If you just look at the earnings surprises around Netflix, I mean, are we going to stop this guidance around this company? Because to try and project where subs come in just seems like it's all over the place.
Paul Sweeney owns this with 30 and 40 years of serious entertainment analysis. He says, look, it's a whole new world. And to Mr. Iger's defense and Mr. Zaslav at Warner Brothers Discovery, you know, there's a mystery. Jessica Reif Ehrlich yesterday,
She's great.
She's plus on WBD and Netflix.
Do you want the post-earnings price action on Netflix for the last four before this one?
Yeah.
Up 13%, up 7%, down 35%, down 22%. That's just how wild earnings days are for Netflix.
John Tucker emails in. He can see you at the Wobbly Barn, you know, with a Budweiser in your hand. I can just see it.
Oh, no.
John, at the Wobbly Barn, there's no choice.
Really?
Yeah, then there's a pickup barrel.
An Englishman can't have a Budweiser, Tom.
I know that,
That's
but
just like, you know.
When you're in Killington, Vermont,
we have a word for Bud. I'm going to give you that in the commercial break. Kelsey Barrow's coming up from JPMorgan. Looking forward to that.
If she dares.
This is Bloomberg.
Can't wait to hear that word. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, Google is joining the list of tech companies drastically scaling back operations. Its parent Alphabet says it will cut about 12,000 jobs. That's more than 6% of its global workforce. Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. In Germany today, the U.S. and its allies are meeting to discuss more military assistance for Ukraine. The U.S. has unveiled a new aid package that includes 90 Stryker armored personnel carriers and 59 Bradley fighting vehicles. Meanwhile, pressure is mounting on Germany's Chancellor Olaf Scholz to deliver Leopard main battle tanks. President Biden says he has no regrets about his handling of the discovery of classified documents at his private office and his home in Delaware. Now, he predicts an investigation will find no wrongdoing. The president told reporters he's cooperating and, quote, there's no there there. International sanctions are dampening China's demand for Russian oil. Chinese imports of Russian energy fell last month to their lowest since March. In early December, the Group of Seven imposed a price cap on Moscow's oil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
With the exception of Netflix, everybody is losing a lot of money. Linear pay TV universe is declining and declining quickly. And the viewers are going to streaming. They want to watch what they want, when they want. The biggest issue facing streaming is churn. And consumers, it's very easy to churn on and off these services.
One of the best in the last 24 hours. Just a brilliant conversation with Jessica Reif-Ehrlich there of Bank of America. From New York this morning, good morning. Looking at equity futures shaping up as follows on the S&P 500. Positive 0.1%. Yields a little bit higher, up 4 basis points. 343.29. The focus on Netflix, positive in the pre-market off the back of earnings, Tom, which just absolutely crushed subscriber estimates.
We're making it up as we go. Let's get right to it. This is an important conversation. We had a lot of fun with this. Thank you for the many comments on Wednesday and the rest of it. The Mandalorian's coming out, I think, for Disney Plus. There'll be a huge splash there as well. We're going to get some true perspective here, like Jessica Reif-Ehrlich, from a true adult in the business. Geetha Ranganathan is with Bloomberg Intelligence, but far more links in the social and the behavioral of this new world of streaming and Netflix with the math and the finance. Geetha, thank you so much for joining. With the uproar this morning on Wednesday, I will actually start watching Wednesday this weekend. Are Netflix's world, their numbers streaming, is it adjusted by binge viewing? Or is there any whisper of a Netflix that is like CBS and Gunsmoke 3 generations ago?
It is not adjusted for binge viewing. I mean, I think that if at all, they've really benefited from binge viewing, that this is something that they've spoken to always. And, you know, this is why we're seeing some of the biggest numbers, because they kind of give customers that choice, that ability to watch all episodes all at once. And I'm going to join you on Wednesday. I mean, this has become one of their biggest English language series after Stranger Things, 4th season. And, you know, yeah, it just kind of speaks to the power of their content, which I think was the main driver of that 4Q subscriber blowout.
The subscriber dynamics, do you see a trend, or is there so much noise, tumult, turmoil that you need more quarters to understand a stable vector of subscribers for Netflix?
I think there's going to be a lot of volatility, and I think the company understands this as well, which is why they're going to stop, or they have already kind of stopped providing guidance going forward. There are just too many different initiatives right now in the works, whether it's that new ad-supported tier, whether it's the crackdown on password sharing, and they kind of expect a little bit of bumpiness down the road as well as they kind of implement all those new initiatives. So yes, it is going to be a while before we kind of reach that steady state, if you will. For the longest period of time, we thought it was going to be this 25 million subscriber ads year after year until, you know, we kind of had that whole meltdown last year. So at the end of it, they actually posted 9 million subscriber ads for 2022, which is actually pretty good. But now as we kind of look forward to that number, where everybody's kind of trying to parse out what that number is going to be going forward as they kind of try to piece together their models, it's probably going to be anywhere from about 15 to 20 million is what I'm thinking. But again, it's hard to say with any huge level of conviction at this point.
Geetha, let's talk about austerity. It's hitting big tech. You can see that in Google this morning. 12,000 jobs to go, 6% of the global workforce. Has that austerity hit the streaming industry yet?
It hasn't, but it has to. And Netflix has kind of been the first example there in terms of paring down on content costs, which is really one of the biggest, cost centers for them. So they've kind of, taken that down to, it's about $17 billion is what they've kind of projected. The big question now for the rest of the streamers is, first of all, the rest of the streamers need to follow suit. Netflix is the only one, as Jessica Reif-Ehrlich pointed out, Netflix is the only company here that's actually making money. They generated about $5.6 billion last year in profits, while the rest of the streamers made about $10 to $11 billion in losses. It's going to be a similar situation again this year, but what we're seeing Netflix really do so effectively is not just pare that content budget, but also go after non-content costs. So whether it's marketing, whether it's, technology and development, whether it's other, operating expenses, we're kind of seeing real leverage there. And that is something where, Disney now really needs to execute. Warner Brothers Discovery really needs to execute. Kind of with that subscriber land grab phase coming to an end, they really need to see where all they can kind of trim costs.
Can we just build on strategy around the content? So if content spend is under pressure, can you tell me how that shapes the kind of money, the kind of content they spend money on, and how that content is ultimately rolled out? Does that change going forward?
I don't think it changes dramatically. I think Netflix, the reason we saw them kind of burning through $3.5 billion in cash just a few years ago, kind of spending so much upfront, was because they were kind of preparing for this day as they kind of made that shift from licensed content to originals. So a lot of their upfront investment is already done. And they kind of have now fine-tuned their algorithms, fine-tuned their formulas, their AI to kind of see what content actually resonates. And we saw great evidence of that in 4Q. Multiple titles performing so well, whether it's Wednesday, whether it was, Knives Out. And they actually said that 2022, five of their 10 most watched series ever actually came in 2022. So I think investors are now kind of finally comfortable with the idea that Netflix has that formula. They have that magic equation to produce hits.
Geetha, that's brilliant, and I see it, frankly, in the Keene household. It's certainly been a Netflix Q4 in terms of, what everyone's watching. And Geetha, to me, it's about the margin. In the old world of Brian Roberts and Comcast, there's 30 cents on the dollar down to EBITDA. Netflix has modeled out a very successful lower EBITDA margin of about 20 cents. Do you have any confidence at all that their brethren can get to a 20% EBITDA margin, or are they all going to be taken out by 3 lone survivors?
Yeah, that's a great question, and that's the the big head scratcher right now in the industry. So they've already achieved 20% margins. They're guiding to about 22% for 2023. And yes, it's going to be a very, very long road to profitability, because at this point, nobody's making money. Other than these guys, nobody's making money in the business. Yes, we do finally see this kind of light at the end of the tunnel where a lot of these companies will probably get to that 20% margin, but it's going to take a while.
Okay, I don't want to put you under any pressure. Nobody's listening this morning, except, Muhammad was listening, but he went over to start watching Wednesday on Netflix.
Is that what he's doing?
Yeah. Geetha, who would Netflix buy? Give me the Geetha Ranganathan fit. I wasn't rude to Jessica and did this. I'm going to be rude to you. Give me the single best buy for Netflix now to really make a consolidation splash.
I think they've already kind of got the content piece. I think what they really want to go after right now is gaming. So probably a gaming studio, but we'll have to wait and watch what happens with Microsoft, Activision, and then there are so many targets that kind of come up. I think the one area that they feel that they can, because remember, the one thing that they really want, and everybody in the streaming industry wants, is engagement. And that's exactly what you get with video games, kind of that captive audience, people spending 2-3 hours at a stretch. And that works perfectly for a platform like Netflix.
Geetha, wonderful. As always, Geetha Ranganathan there on Netflix and beyond. The stock is up by about 6% in the pre-market. Tom, after absolutely crushing subscriber estimates.
So that's like Call of Duty and all that stuff. It's like where kids sit at home.
They just, to Geetha's
do you do
point,
this? Do you do gaming at home?
Absolutely not. Do you want my rant on gaming? Let's save that for another time. We'll save that for another time. I think once you get to a certain age, you shouldn't have a games console, but that's just my view.
Be careful.
There is a whole industry dedicated to get people to stare at a screen, Tom, so they can sell whatever they want to sell around.
Of course, that's the game.
That's the game.
That's the game. Yeah.
It doesn't matter if it's content or gaming. It's the same thing.
My answer here is, and I feel like I'm channeling Robert Iger of Mr. Iger of Disney, it's still about content. And as Geetha said, what we can say now that we couldn't say 90 days ago is that Netflix right now is hitting the ball out of the park. They have this one. I don't know what they are. I mean,
Austerity. Can we discuss that just a little bit more?
Yeah, okay.
In Google,
British,
in Microsoft, in Amazon, they're all starting to cut back. And to Geetha's point, they're going to have to cut back on content too, Tom. I wonder if it does change the way things are rolled out. Are the days gone where they just used to dump the whole series all at once? You could binge it in a couple of days.
Disney's working
and move on.
I sort of like the way Disney does it. I'm sure they'll do this with Mandalorian, where you sort of know in your head in your busy week that on Wednesday or on
the
Friday,
episode's going to drop.
It's going to drop. And I'm speaking as an amateur, I think that's where the industry's heading rather than the binge thing.
Isn't that what they did with House of Dragon? I think it is.
I never saw that.
Did you not watch that?
No, I didn't.
But I thought you loved Game of Thrones.
I just, there's only so much time. I'm like everybody else watching this. Where is the time to watch this when I am riveted by the excellence of the Tottenham Spurs?
Oh, were you riveted by that yesterday?
Riveted.
We've got a minute left on the clock. Do you want to talk about Spurs City?
I didn't watch the game. I watched carefully the afterwards. They don't have a defense. Forget about the goalie. Blame the goalie. Shoot the goalie. No. Where's the defense?
They've got one good defender.
Which defender do they need to buy?
Romero. They've got one good defender.
But who should they go out and get? Help.
It depends how much money they've got.
Oh, come on.
I don't know what the budget is. I don't know
Call
if
up
Antonio
Adele.
Conte is going to stay.
Call it. They could do a concert with Adele there.
With Adele to raise
Adele
money.
could do a concert.
You want to do a fundraiser with Adele so you can buy a defender.
Do a fundraiser. Emma Raducanu can show up.
Is that what it's come to for Spurs?
Yes, what it does.
Is that what it's come
They
to
need
for
a
Spurs?
fundraiser to get a
Fundraiser for transfers. Okay.
There are too many problems that investors have to overcome in the first half of this year.
Now we're starting to see more dispersion in the data, in the economic outcomes.
It's going to be a harder environment to see fiscal and monetary response, and we think that leads us to an equity market that can have some healthy declines this year.
I think we are very much revisiting the more normal dynamics now.
The story this year is the earnings risk and the recession risk, not the inflation risk anymore.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance on TV and radio. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro. Equity futures on the S&P totally unchanged. The headline of the morning so far, TK, comes from Google, cutting 12,000 employees, 6% of the global workforce to go.
It continues. You know we're going to see a lot more of this. And I think far more importantly, within other sectors away from tech and the luxury tech has had for 10 years, you're going to see 2% and 4% kind of cuts from many, many other companies, some of which won't even make the news cycle, but they're out there. It is a layoff America.
Doesn't this feel like the banks after the financial crisis, Tom? All that excess and then just cuts. Huge cuts, tens of thousands, 20,000.
I mean, we've addressed this across the show today, and folks, we're doing asset allocation here, really in the first two. Like, what are we doing into February? John Golub and who do we have? Hollenhorst is with us in the next hour?
I believe so, yeah.
That's the interview of the morning.
Cassie Barrow coming up in 30 minutes too.
Yeah, it's going to be interesting as well. But to get back on this, John, there's a shift going on, and Silicon Valley is not the banks. It's an attitude adjustment.
Sure.
And this is the word, and you know I hate this word, we're going to innovate. John and I haven't innovated in like 30 years. It's the same thing as they were doing 40 years ago.
So let's clarify this.
Innovating.
Let's clarify this.
Innovating.
I'm certainly not saying it's the financial crisis. What I am saying is you've got one industry that has built up a ton of excess, not just over the last 2 or 3 years, but over the last decade, Tom. They've had money thrown at them. To your point, they just scream the word innovate. Here's some money. I'll write a blank check for you. Those days are over with rates through 4%. Those days are gone.
Shonali Bassett keeps next to her desk. It's white walls here at Bloomberg, very conservative. And she writes in pencil all the buzzwords that she gets from Wall Street.
Innovate.
And bankers. Innovate is about 20 words
Disruption.
down.
Do you remember disruption? Disruption. The disruptors.
You know, there's others we make
I tell you the
fun
phrase
of,
at the
but-
moment from the C-suite in Silicon Valley, this one right here. I take full responsibility for the decisions that led us here. That is coming from Sundar Pichai this morning of Alphabet. We have heard similar things, Tom, come from Salesforce. We've heard similar things come from Satya Nadella of Microsoft this week. Satya Nadella of Microsoft, I think, is being so upfront, Tom, about the challenge they face, not just the rest of this year, but for the next few years. They're being very, very open and transparent about it.
Here's the Google comment from Alphabet, I should say, excuse me, as my folks pa, I should say Alphabet CEO, full responsibility for the decisions that led us here. These are important moments to sharpen our focus, re-engineer our cost base, and direct our talent and capital to our highest priorities. Does this mean they're going to get rid of Google Glasses?
You think that's what's going to go?
Is that,
to your point, you joke,
you know.
but ultimately there was that division where it was like to throw money at the wall and see what
Well-
sticks. I don't think people have the luxury of having those big divisions done where you can just throw the money at the wall and see what sticks.
Under the radar today, Ed Ludlow told me this. There's the virtual reality silliness.
Yeah.
Okay, and
Apple getting in on it.
pulling back. They're doing some kind of, Mark Gurman, I believe, has the reporting on this. They're doing a low-cost idea. What is that about? They're listening to the customers. There's no audience. And that's what Google and the others are dealing with.
There's a rate story here as well. Vice Chair Brainerd yesterday, we're going to stay the course, determined to stay the course. President Lagarde this morning in Davos, Switzerland. Guess what? Staying the course is my mantra for policy.
Are we staying the course?
We're going to stay the course, hopefully, through to 9 a.m.
Try to
Eastern
get to
time.
9 a.m.
After 9 a.m. Mohammed's coming up a little bit later.
Oh, we have.
Yeah,
I have
great
Mohammed.
lineup. No, I have Mohammed.
Oh.
Great lineup in the 9 o'clock hour. Do you want to hear it?
Oh, please.
Al Arian, just to open the hour, and
Yeah.
then to close the hour, Robert Koenigsberger of of Gramercy funds
Very
on
cool.
EM.
Very
on
cool.
EM, so it's going to be very, very cool.
That's good.
You looking forward to that?
Yeah.
You can drop by from radio and join in if you want.
I think I've got Tuesday to talk about Wednesday.
Equities right now on the S&P, just about unchanged. Futures positive by almost 0.1%. No real drama here. Yields a little bit higher by 4 or 5 basis points on a 10-year. 343.84 is where your 10-year is at the moment. And no real drama on euro dollar, 108.24. Though, Tom, you've said it. Look at crude. It goes from 80 to 81. $81.04. We're up 0.9%.
Will Kennedy was great on this the other day. $86 on Brent crude, and that's the quiet story here of a persistence in oil discussed at Davos. You know what? It doesn't matter about the great and mighty at Davos. It's about EM recovery, and that seems to be the mystery.
Let's start the market conversation right now. We can do that with Tracy McMillan, the global head of asset allocation strategy at Wells Fargo Investment Institute. Tracy, great to catch up with you. I think you've picked up on a theme that I'd love to talk about. What's bad for the economy is good for the stock market. That mentality has persisted for a long, long time. Have we finally crushed it to pieces?
So we do think that investors are now focusing on growth as opposed to bad news is good news, and that will change the direction that the Fed is taking with interest rates. But we have a Fed here who's not backing down. And, as you mentioned, we have an ECB that's not backing away either. So investors are really realizing now that a serious growth slowdown is probably ahead of us. And that's consistent with our view that there's probably going to be a recession later this year.
Tracy, Wells Fargo Economics has a glorious heritage of measuring the American unemployment, the American labor situation. The numbers yesterday were stunning. We have, I believe, a fully employed America, and then there's a debate about that. How do you asset allocate if you believe at some point labor breaks and becomes a higher unemployment?
Yeah, so the way that we have been positioned really since about March of last year is overweight fixed income, underweight equities. So we're taking that more defensive approach, but we're not completely out of equities. And we are allocating within those broad asset classes. So within fixed income, we like investment grade over high yield. And specifically, we like short term and long term over intermediate term. And we see that short term in particular is a source of funds for equities when the time comes to put money back into equities. We just think we've got to get further through this cycle before we do that.
This is critical. You say further through the cycle. Is it further through a corporate earnings revenue cycle, or is it further through the Fed Babel central bank cycle?
So actually, those two are in some ways going hand in hand. Of course, the Fed policy will lead the corporate earnings cycle, but the Fed policy cycle, we do think will probably end early this year, and they'll pause and potentially even start cutting by the end of this year. And that's consistent with history and how they raise rates. Then earnings tend to be hit afterwards, market bottoms, and then the Fed starts cutting. So that's the cycle that we're anticipating this time. We don't necessarily think it's different this time. We don't think that we're necessarily going to see that soft landing or Goldilocks scenario. We think we've got to go through this recession.
Tracy, as we speak, Neil Dutter of Renmac writes in, a serious slowdown with initial jobless claims cratering to fresh lows, ? Tracy, how is any of this consistent with what we're seeing in jobless claims in America at the moment, which yesterday came in at 190,000, which is exceptionally low?
Mm-hmm. Yeah, so we do think that there is going to be, like I said, a contraction, a recession, but it doesn't necessarily mean that jobs are going to crater. We are starting to see layoffs in the tech sector. We're seeing layoffs in those industries that really overhired during the pandemic, and we think that will filter through eventually to other industries, other sectors, as we move through a period where their earnings just can't sustain the workforces that they have. So we do see unemployment in the 5% range by the end of the year. That's not cratering, but it is a slowdown in labor.
Where's the growth backdrop against that?
Yeah, so the growth is probably going to be in areas where there's more pricing power. So we like things like energy, we like healthcare for the defensive posturing, and believe it or not, we actually like information technology here at these prices. We do think that longer term, what we're going to see out of information technology is companies moving more towards technology to supplement a labor force that is likely to have low participation for a very long, extended period of time. It's a demographic shift.
Is it too early to make that move to tech, given the cyclical challenge they might be facing? Look at the decisions they're making right now. Those days of that secular story seems to have faded. This seems to be about the cycle now, the discipline of 4 or 5% interest rates. Are you worried about that?
So we are. Of course, interest rates are hard on companies that depend on growth. And certainly technology is among those sectors that depend on growth. So as we move again through this cycle, we do think that interest rates are going to come back in a little bit, and that is going to provide support. But we also see it as a longer term kind of play. So we would be dollar cost averaging in here, but we wouldn't necessarily be overweighting technology significantly.
Tracy, thanks for being with us and giving us your thoughts. Tracy McMillan there of the Wells Fargo Investment Institute on the challenge of the moment, Tom. You've got bond yields lower off the back of people worrying about the economic data in our present and in our future. So you've got to think about, do I get the valuation relief off those lower yields in tech, or do I get the earnings headwinds off the reason why those yields have been lower in the last couple of weeks?
On a Friday, you look at asset allocation because that's what everybody's doing. And it's not funny, John. It is a weekend where you have to readjust your 201k. That's what everybody's doing in January. I haven't said that in years. We used to make a joke about it, John Tucker and I. But Tracy's dealing with a bank with thousands of 401ks that are now 201ks. What's the line? And what I heard there is wicked cautious.
And everyone's saying fixed income. Tom Pilot,
scared,
the bid into fixed income.
All my radars up on this consensus bet.
Do you get frustrated by the fact that the mood seems to change, whether the market is up or down? We have a down week and all of a sudden it's about the damage done to GDP off the back of monetary policy tightening, and you have 2 weeks, 2 weeks of gains, and it's all about China reopening.
That's the parlor game. But the people in asset allocation are out there trying to sell a message for a big bank. I mean that in a constructive way.
They're trying to sell fixed income.
Let's
be very clear about that.
They're selling caution after the carnage that's led to my one. I mean, I have a 101k. Forget about 201k. Look at the Wayfair headlines. Squeeze them in, John.
10% of the global workforce to go, Tom.
Wow.
1,750 employees. Includes 18% of corporate employees.
Wow.
As well. I've heard a lot of people frustrated this week about the decisions the C-suite are making at the financials. What you hear from the big players on Wall Street. The cautiousness, the conservativeness. And then at the same time, you hear the bullishness from the research departments.
Yeah, I think there's a bit of
I think
there was a
separation
at Davos as well. Yes.
You witnessed that too?
I witnessed that.
The happy talk in Happy Valley?
From a distance.
Yeah.
Nancy Griffith moment.
Did you miss that this week? I have not missed that this week.
I missed it terribly.
Did you?
Frankly, yeah.
I have not missed the happy talk in Happy Valley.
You know, barley soup at $40 a cup.
Nice. Futures positive a tenth. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The parent of Google has become the latest tech giant to retrench after years of growth and hiring. Alphabet will cut about 12,000 jobs, more than 6% of its workforce. CEO Sundar Pichai says the cost will affect jobs across the entire company. Pichai says he takes responsibility for the decisions that led Alphabet to this point. The Biden administration is sending another major package of military hardware to Ukraine. It includes 90 Stryker armored personnel carriers, 59 Bradley fighting vehicles, and millions of rounds of ammunition. The package is valued at $2.5 billion. The U.S. and its allies are meeting in Germany today to discuss more aid. The Supreme Court says it hasn't been able to identify who leaked its opinion, overturning the constitutional right to an abortion. During an 8-month investigation, the court's aging computer system was examined and 97 employees were questioned. The court called the leak a grave assault on the judicial process. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What people assume is that there's going to be a lot of drama, but in the end, the debt limit will be raised in time. Now, so what that means is if we mess up even just one time and don't raise the debt limit in a timely way, it's going to be a huge market surprise. So you go from thinking that the probability of default is 0.01% to all of a sudden there is a technical default. It'd be a huge blow to financial markets.
Bill Dudley there, the former New York Fed president and current Bloomberg opinion columnist. Great to catch up with him. From New York, equity futures up about 1/10% on the S&P 500. Yields a little bit higher by 4 basis points on a 10-year. Your 10-year looks like this, 343.47. Tom, on the 10-year right now.
Well, there it is. And it's churn the market. I don't know. We were down yesterday. We were going to go to 3.99 on the 2-year yield, and we've walked away from that.
Sure.
Yeah.
But we've had a big move lower in the last couple of months,
Yes.
that's for sure.
Yeah, absolutely.
But I'm with you. Back to about 417.
I'm not sure what we're doing with Sonali Basak, but she is, with the uproar in Bitcoin, she's coming in. The Bitcoin itself is 21,000, hasn't done much, but the news flow in crypto is absolutely extraordinary. Look for our crypto expertise, I should say, on Tuesday, where they'll sum what is a moving story. Right now, in Washington, there is a moving story. Anne-Marie Horton joins us right now on the president's weekend. Does the president go to Delaware to go into his garage and look at selected papers? I mean, I'm a little bit lost here. They used to go to Camp David, used to be what you do. Nobody goes to Camp David anymore. What's a president's weekend look like?
Well, there are still some trips to Camp David, but yeah, they are much less numbered than, say, the president going to his home in Wilmington, or in the summer at Rehoboth Beach in Delaware. He does like to go home on his weekends. We saw this with the former president. He used to go to Mar-a-Lago, his golf course in New Jersey. He's not going to go home looking for documents. I mean, the White House has made it pretty clear that now they believe that this is in the hands of the Justice Department. There's a special counsel. Mr. Hur is going to be handling this. But the president commented on yesterday saying he had, quote, no regrets about how it was handled. But there are so many questions, obviously, about this. And someone actually writing into me after the last hour saying also their question is really about why were the documents found in the first place? What were they looking for? But this administration is going to want to really make it clear, black and white, how they handled it versus the former president.
The reason I brought this up, Anne-Marie, is this is the weekend where he decides to run for office. And I don't understand this. Does the present president have to wait for the former president to announce he's running for office?
Well, the former president has announced he's running for office.
But I mean more
We haven't seen a lot.
Yeah, makes a bigger
maybe more
splash
announced,
about
meaning,
it.
maybe have some rallies, etc. I mean, a lot of people are thinking potentially, will the former president drop out? You haven't heard a lot from him. But the end of this month, he'll be holding something in South Carolina. They are starting to send out, at least on the campaign side, not his Truth Social, but send out a lot more emails and advisories about this. You know, there was a recent poll, though, from Suffolk County and USA Today about 5-6 days ago that showed that if it was between these three people, and I'm adding DeSantis in this, President Biden would still beat Trump, but Governor DeSantis has a narrower margin over President Biden. So we are waiting for everyone to get in this race, and we still have time.
What did you learn about Ukraine this weekend? It is a jumble of threads, I would say, Anne-Marie, which is like any war. You're going to get different threads in this. I was struck by all of a sudden the word Crimea is coming into the dialogue as well. But you are glued to this story. Inform us on what we need to know into the weekend about a war 1 year old.
Battle tanks, Tom. I mean, today, really, you have this defense contact group meeting in Germany. Lloyd Austin, the U.S. defense minister, is there. And there's this public spat. I don't think they want it to become public, but Germany, and the reporting is that Germany is pretty much saying, we will not supply Leopard 2 battle tanks or not allow other countries to supply them, like Poland, which already said whether or not Germany gives the okay or not, we're sending them. Germany is saying we will not send them unless the U.S. sends their Abrams, which is almost comparable, or it is more of a wartime battle tank. This has now become out there in the public. And what you had from the economy minister, Robert Habeck of Germany, saying that it would be much easier for Germany to do this if the U.S. was on board. Now, there are logistical and technical differences between these two that if you talk to defense experts, they'll say the Abrams have a jet engine, they need a lot more fuel. The Leopards, there's hundreds of them. Tons of NATO countries have tons of these tanks. But you can still see that reluctance in Germany, right? They had forever this foreign policy with the former Soviet Union of Ostpolitik, building these commercial bridges, not being too defensive when it comes to Russia. They have made a massive U-turn, and you can still see them lingering a little bit when it comes to these decisions because they don't want to provoke Russia and that this spreads outside of Ukraine's borders.
So which one is it? Who's hesitating here, Anne-Marie? Is it the Germans or the United States?
That's a good question. At this moment, it feels like it is the Germans hesitating because you have other countries like Poland saying, we will send those Leopard tanks, but because they're German-made, we need Germany's sign-off, or Germany saying that they would need to give that sign-off. So if you have countries already lining up, waiting to send them in, and they're waiting for Berlin's green light, and that's not happening, I would say at this moment it does look like Germany is the one that is hesitating. Although we did hear from Boris Pistorius, who's now the brand new defense minister. He's been in the job 48, 72 hours, and he said he wasn't aware of such package, meaning this deal of I'll send the Leopards if you said the Abrams. So potentially, let's see what the news is out of the contact group today at Ramstein, and if not, this debate will go into next week.
Anne-Marie, just out of interest, just to put two stories together, does this debt ceiling debate and how money is spent in this country shape how this war in Ukraine between Russia and Ukraine is supported by the United States?
Well, we saw more than 2 million already draw down this week from to go to aid to Ukraine. But there is a linkage because what you have in discussions in Congress and these backroom deals McCarthy was making is that they want to cut spending, 130 billion at least. And there are reporting, especially from us, that potentially this could be defense spending. Potentially that means aid to Ukraine. Now, potentially this will not be an issue for 2023, but certainly if this war continues into 2024 and 2025, this is going to be a major discussion.
AMH down in DC. Anne-Marie, thank you. As always, the latest from Senate Republican leader Mitch McConnell. He said the following: periodically, the debt ceiling has to be lifted. It's always a rather contentious effort. He went on to say, Tom, in the end, I think the important thing to remember is America must never default on its debt. It never has, and it never will.
It's as straight as you can get, and this,
it's always bizarre. Every single time we do this,
and it goes back. I mean, the history of this is real simple. It was up to 1917, up to the realities of World War I. Congress controlled it in a traditional way that we learn in civics class or social studies, whatever you want to call it. And then it was amended through the Depression and the crisis of that. And in 1939 and 1941, they changed the rules. It's just as simple as that. And that's where this started in. And particularly for our international audience, and John, I think this is very foreign to the British process. There is a huge politics here wrapped around not so much religion, but just what is debt? Is debt evil? Is debt good?
Well, it depends if you're in power or not, right?
And Rogoff and Reinhardt, capture this in their wonderful book, and there's others as well. But is debt evil? Is debt good? This is a moral thing that folds right over to particularly Republican politics. I'm sure there's Democrats that feel the same way, that debt is evil.
Try and talk about this with anyone in the bond market right now, Tom. They just shrug and say, can we talk about something else?
Yeah, Brian Weinstein.
And the question we're asking, is it different this time? Kelsey Barrow's going to join us shortly. Looking forward to that. Portfolio manager at JPMorgan Investment Management. That conversation coming up. Equity futures right now up 0.1% on the S&P. No real drama here with Tom Keene. I'm Jonathan Ferro. This is Bloomberg Surveillance. Live from New York, equities up 0.1%. Here's a flavour of the price action for you on the S&P and on the Nasdaq too. On the Nasdaq 100, positive right now by 0.5%. Equities pushing just a little bit higher. In the bond market, 2s, 10s, 30s look a little something like this. Your 10-year in the 330s a little bit earlier this week. Right now, 343.29, up 4 basis points on a session, but down and down hard from where we were back in October at about 433, 434. In the FX market, Tom, we look a little something like this on euro dollar. Not doing much this morning. We're down 0.1% or so at 108.19. And President Lagarde echoing the words of Vice Chair Brainerd yesterday. Vice Chair Brainerd said we need to stay the course. We're determined to stay the course. And President Lagarde this morning said staying the course, Tom, is my mantra for policy.
Let's go to the real yield and in curve inversion. We've got a greater curve inversion, John. We're not out to negative 80 basis points, but on a moving average basis, the curve inversion 2s10 spread has my attention, negative 73 basis points, a difference in yield of 0.75% between the 2-year higher than the 10-year. And John, all of a sudden on this Friday, can we consider a 10-year real yield that would fall below 1%?
That would be interesting.
We haven't framed that
Would
yet.
the Fed push back against that if that started to develop?
They'd have to. I mean, I got a Bloomberg Financial Conditions Index, which is anti-Powell. And if you get a continued diminished inflation-adjusted yield, what do they do February 1st? Hollenhorst in the next hour will discuss
Looking forward to that. Clearly, those high real yields are starting to bite in big tech. Let's take a look at 2 names for you and start with Alphabet. Google cutting 12,000 positions. We're talking about 6% of the workforce. The stock reacts positively to that, up 3.6%. And Netflix, Tom, up in the pre-market by 6 or 7 percentage points, just to go through those numbers again. The company added 7.66 million subscribers in the final quarter of 22. The average estimate was about 4.5 million. And I've gone on a rant about this before. The estimate game is just shut your eyes, throw a dart, and see what it lands on.
Yeah, and I wonder if it's a password thing where they started getting stricter about password. I mean, VetBill uses my password.
Maybe.
You know, I don't know.
I'm going to crack down on that a little bit more.
Scope and scale, I'm going to bring this up, and so somebody can tell me I'm wrong. Google is 10 times bigger than Wayfair. Google's got 180,000 plus employees. Wayfair has 18,000. And I'm watching the Wayfairs of the world. Google gets all the press and
10% of the workforce.
Amazon and all that. I'm watching the cumulative Wayfair into the in the earnings season.
I'm comparing it to jobless claims at 190,000 and wondering when it starts to show up.
Yeah.
It's pretty impressive that we're still at 190,000. We see headlines like this, left, right, and centre.
Should we move forward?
I would like you to, yeah.
I think we should. What we're doing here is we're talking to people about asset allocation, but that rolls over into hardcore, careful strategy. We enjoyed a lengthy conversation this week with Mr. Michael of JPMorgan. I thought he was informative. Why don't you bring in our next guest who has a diametrically opposed view to Bob Michael?
Kelsey Barrow, I think on the same page, portfolio manager. Kelsey, it's wonderful to catch up. You've heard all this communication from central banks worldwide, from the ECB, from the Federal Reserve as well. Have we seen peak rates, and how far can this Fed take things?
Yeah, so I do believe we've seen peak rates, particularly as it relates to the long end, 10s and 30s. But there's this motto, higher for longer, right? I think this higher for longer motto could be the new transitory. So let me explain exactly why. So the Fed was saying transitory. Inflation is transitory. The market didn't believe it. They looked through it. They priced ahead of the Fed. They pushed the Fed to hike more. Now we're seeing actually the reverse. The market is saying, let's keep rates higher for longer, higher for longer, higher for longer. And what is the market saying? I don't believe you. It's pricing in rate cuts. It's already seeing the data roll over. And so the Fed's going to keep trying to communicate higher for longer, but the market is already looking through it. The market is leading the Fed on the way up and leading the Fed on the way down as well.
You think the market's right?
I do think the market is right. I think the market is seeing things in the data. You highlighted is a manufacturing. It's been below 50 for 2 months. We don't just look at the headline index. We dig into the numbers. For instance, you look at the ratio of new orders to inventories. New orders is falling. Inventories is rising. Not a good situation for companies. That level has never been this depressed outside a recession. I think it's just a matter of time before we see in the initial jobless claim numbers what we're seeing in the rest of the economy.
What do you see in vanilla corporate debt? You don't remember when there was a blue S&P book and you'd thumb through it to see what Boise Cascade was doing with their massive 3% coupon. But corporate debt matters, and now there's a lot of issuance as well. What's that dynamic? How do we take advantage of that?
Yeah, so we do see a lot of opportunity in investment grade credit. We think that the yields there are attractive to get invested, and we're staying very high quality.
What's a typical yield there? Very high quality corporate.
So you can get between 5 and 6%, depending on the maturity, depending on exactly.
Yeah, that's almost what triple leveraged all cash does. I mean, it's not there yet.
How's that portfolio doing,
It's
Tom?
doing good. I mean, it's really out there with a nice pop, but netted to the 2s20s take.
Crazy inflows for you last year.
It was amazing. But if you take out the 2 and 20 fee on the triple leveraged all cash, it doesn't get down to Kelsey's.
We need to talk about high yield. Never mind IG. You've talked about where you're at on this economy. Some people might be different. They might look at jobless claims and say we're still resilient. What recession? You're on the other side of that. I get it. So Treasury yields have peaked. You think ultimately the Fed can't go as far as it goes. Got all of that. What business does high yield have rallying in that world?
So we were talking to our portfolio managers within our high yield desk this week. And yeah, I mean, we were getting that same sense. We're not seeing huge demand into high yield so far this year. What we're seeing, I think, is more technically driven. There's no supply. So essentially, the people who are looking to get invested are just driving spreads tighter. It is incongruent with the data that we're seeing. I think it is more technically oriented. And we're still staying defensive, looking forward to what the data is telling us and what company earnings are going to say, which, we're not particularly constructive on.
So this is just the sales force that all these big asset managers going around saying, buy fixed income. It's all the inflows in the new year coming into fixed income funds. Ultimately, you think that's going to fade for some of these credit stories?
So when we say buy fixed income, we're focused on high quality. So when you think about somebody investing into the aggregate, that's generally treasuries, mortgages, and investment grade. And so, the whole spectrum of the fixed income universe is going to benefit from those flows, undeniably. But, when we're thinking about adding duration to portfolios, you have to think about not just the mathematical calculation of duration, but the empirical duration. So how does it actually trade when treasuries rally and there's a flight to quality, safe haven bid? Investment grade is going to get capital appreciation. Prices are going to go up on those bonds when it's risk off. High yield, if spreads are blowing out, you're not going to get that.
And you expect high yield spreads to blow out this year?
So we are still anticipating a widening of high yield spreads when that recession comes. And timing that recession is difficult, but when we do see that recession, spreads tend to widen to at least 800 basis points.
Guys like you at 60,000 square feet. Kelsey, I love to go to the individual. I'm looking at a high quality piece, which I bought, John,
what was
at
that?
par. It's like this close as I get to golf.
Was it the Century Bond in Austria?
No. It was better than that. And I've enjoyed the Google piece of 50 this century. Okay, 50. So I'm out 30 years-ish, 2.2% coupon, 2.05. And I've seen a price reduction of 100 down to 64. Is that an opportunity? Something like that? Is that high quality corporate when a ginormous company like Google is on sale for 30, 40% under where it was?
Yeah, so, within the bond market, to kind of translate that, one of the attractive opportunities that we've been finding is when yields are rising, you're having a lot of bonds that you can buy below par at very discounted dollar prices. And so, those are opportunities. And we want to be investing in companies where we have vision on the cash flow. We know what they're doing in terms of leverage.
Right. I mean, and then I want to be fair here in that Bob and Kelsey are not in the individual name. That's not their mandate at JPMorgan is not to give us individual names. I'm just picking this out, John. I don't think our audience understands yields up,
price down,
100 to 63 on a 30-year piece at Google, which is not a high-yield bond.
Do you want to take the 30-year piece at a tech company? Can we make it broader than that? Is that the kind of risk you'd want to take?
So I think that we were generally all of last year very focused on keeping both our duration risk and our spread risk concentrating in the front end of the curve. So minimizing the interest rate sensitivity of our portfolios. We thought yields would be rising, and of course those longer end bonds are going to get hit the most. Now that we're kind of in the reverse of that story, I think that you can feel more comfortable extending out the curve and extending duration of your portfolios to those 10-year and those 30-year high-quality instruments.
Tough times ahead. 25 or 50 at the next meeting? 25? 25? Yeah. That's it. Everyone's saying 25 now, Tom. 25. Done deal. early February.
And again, Hollenhorst with us here in the next hour to brief us.
Look forward to
here
it. He's
on
dropped
that.
from 50 to 25 too.
Yeah.
Cassie, this was great.
Yeah.
Have you ever watched Wednesday on Netflix?
I haven't.
That's all we want to know. I've never heard of it. Have I never heard
It's
of
the Addams
this?
Family. It's a twist
just
on
who's in it? Do you know who's in it?
I don't know.
Why is it called Wednesday?
Because that's the
focused on
character of the
character
Adams. John,
Wednesday.
get with
In the
American
Addams Family.
culture.
I've got no
The
idea.
Addams Family.
Dun-dun-dun-dun.
Very good.
I've got it.
Nailed that.
Great. That was great. That
'Cause
should be a
that's
jingle for this
Wednesday,
show.
and, you know, my afterthoughts calling me
That's
Gomez.
right.
You know, she's at dinner calling me Gomez, and I'm like, what's that about? But it's just another example, as Geetha said, of their narrow casting to what does Kelsey Barrow want to watch. I mean, they're in Hollywood saying
Not
that.
Wednesday, apparently.
Well, I don't know. There's others.
So what does a portfolio manager watch on Netflix? What does a PM do? Does Bob keep you too busy? You don't watch Netflix?
You know, I like the more mindless stuff when I'm watching
like
Netflix.
what?
Well, Wednesday is Socrates. Okay, continue.
That's not right. What is the mindless stuff?
You know, a baking show.
Like a baking show.
Cocktail competition.
What's the British
Right.
baking show? Francine Lacroix addicted
Yeah, the Great
to it.
British Bake Off, that thing.
Yeah, that thing. I watched.
They moved networks, they changed the cast, kind of fell off the cliff.
Can we bring you up to date on my portfolio? Maybe, Kelsey, hold
Which
my
one?
hand here. We're on TV. Hold my hand. It's not an HR violation. Austria, 97 year. I bought it. I top ticked it.
It's brutal.
140 to
That stuff-
47.
That stuff, when you reflect, Kelsey, just to finish there, on the last decade and what's taken place in this fixed income market,
Yeah.
Tom will look back at a century bond. What will you look back on to say, this was crazy?
Okay, 18 trillion of negative yielding debt at one point in the last decade, now completely wiped out. That's pretty crazy. And thinking about this idea of structurally higher yields, are we moving into an era of that? And I know you spoke to Bob about that earlier in the week. You know, what we noticed, this rate hiking cycle, the first time that we've peaked at a higher level than the prior cycle. First time in 30 years.
In the bond market here, somebody else had this. This goes back to the establishment of Nevermore Academy in Jericho, Vermont. 1788 was the last carnage.
To Kelsey's point, what Bob said earlier in the week, the first time that we've had a higher high in how many cycles?
30 years.
30 years. And Bob is basically suggesting that he thinks we can have a series of higher lows and higher highs at each additional cycle where we get a rate hiking cycle and a rate cutting cycle. I think that's fascinating just to think about unwinding the last few decades. Kelsey, this was great. Fixed income, bit of Netflix. Netflix is up this morning. The stock's advancing by about 6%.
Shows.
Do you want to take us out with a jingle?
I like
what
the
have you
British
got?
chefs. I like the British chefs.
Yeah.
Gordon and Jamie and those guys.
Marco Pierre White was the man.
Yeah, but
he was
they're way better than
man.
the American chefs. You know, they're not in $250,000 kitchens. They got a knife, they got an onion, they're chopping it. Seriously.
Futures responded to that, Tom. Up a third of 1% from New York. This is Bloomberg.
And my daughter, a huge Wednesday fan. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Google is joining the list of tech companies drastically scaling back operations. Its parent, Alphabet, says it will cut about 12,000 jobs. Now that's more than 6% of its global workforce. Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. In Germany today, the U.S. and its allies are meeting to discuss more military assistance for Ukraine. The U.S. has unveiled a new aid package that includes 90 Stryker armored personal carriers and 59 Bradley fighting vehicles. Meanwhile, pressure mounting on Germany's Chancellor Olaf Scholz to deliver Leopard main battle tanks. President Biden says he has no regrets about his handling of the discovery of classified documents at his private office and his home in Delaware. He predicts an investigation will find no wrongdoing. The president told reporters he's cooperating and, quote, there's no there there. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
In the U.S., our research team, which is the best in the business, has a mild recession predicted sort of mid this year into next year. They push that out, and so why they keep pushing out? It's the strength of the U.S. consumer. They have the Fed getting over, 5%, 5.25%. Just this week, they moved that to 3 25 basis point rate rise as opposed to 50.
I've got a ton of time for Brian Moynihan of Bank of America
Always.
on this one specific thing. Whenever he's asked about the economy, he always does this. He refers to his chief economist in the research department. And in this case, in this instance, it's Mike Gapin over at Bank of America. And Tom, I think that is so classy because it causes so many problems when the CEO goes out there pontificating on the economy, on interest rates, and not referring back to what their own research department is producing. And every single time he's asked about it, he does the same thing.
You're busting my chops on a Friday because you know this is a third rail with me. We're going to stop the show for 45 seconds right now to talk about one of my favorite bankers. 24 hours ago, somebody said to me, how did Brian Moynihan become Brian Moynihan? This is a kid out of Brown University who grew up in the crucible of brutally competitive New England banking. And in the Bank of America disaster, out of the Carolinas, the heritage of San Francisco, and the acquisition of the mid-Atlantic states, this guy in that pitched warfare survived, and Moynihan picked up the pieces of Ken Lewis by being a banker first, as you and I did in our conversation with him, and just as you say, farming out intellectual expertise within Bank of America to his economists and the rest.
It's classy. I'd like to see more of it. We don't see enough of it.
I strongly agree. Are we done?
We're done on that. I've just got this one from Liz Ann Saunders of Schwab. The legend of Charles Schwab. Sadly, I remember the original Addams Family on TV in the mid-1960s. That from Liz Ann this morning. Liz Ann's fantastic. We need to get her on the show soon, Tom.
We should. And you know, frankly, she can give us some great perspective on where these markets are and where these industries are. That's what we're going to do now, the culture and the fabric of big tech. And there's no one better with true tech expertise than Mandeep Singh of Bloomberg Intelligence joining us this morning. Mandeep, I'm going to go to a guy who was I'm still not over, folks, the great Clay Christensen dying. It was cancer. He went very quickly. And Mandeep, you know the effect that Clay Christensen had on the religion of Silicon Valley, and that was disruptive innovation. Right now, the disruptive innovation is being moved aside with mass layoffs. Tell us what the next disruptive innovation is for Google, Amazon, and the rest of them.
Look, I think we keep hearing about, ChatGPT these days and just how these companies are pivoting more so towards AI and large language models. But for a company like Alphabet, when you have got a cash cow in the form of search, $200 billion, almost 40 to 50% EBITDA margins, you have to ask yourself, what is it that will protect that cash cow? And I think right now, they are trying to diversify their revenue through cloud. The problem they have is the incremental margin is negative on cloud. YouTube also is much lower than their core search. And look, these companies grew too much in the last 2 years in terms of expanding their employee base. So this is just kind of making sure their operating income at least stays flat. And, they can prove to the street that they can grow their operating margins going forward.
To Jason Del Rey's magisterial effort at Vox on Amazon just out overnight, Mandeep, Jason Del Rey makes clear there's a cultural change at Amazon going on now. Bezos out, Jesse in, and they're going to see if it works. Is there the same issue at Google or at Microsoft where there's a true cultural shift from founding tycoons over to actual adult management?
Yes, I think to an extent that is the case, in terms of how management really pivots to the next phase of growth. But you look at Satya Nadella, what he has done at Microsoft. Clearly, when he came over, there were a lot of doubts around Microsoft, going around Windows to a cloud or something else. And he did that successfully. In the case of Alphabet, I think you still have to ask yourself, this is still a search company. That's where the majority of the profits come from. And what is it that's going to drive the next phase of profitable growth? And I don't know if the answer is autonomous driving, Waymo, or is it YouTube? My bet would be on YouTube because that's a proven business. Connected TV is a real secular trend. And I would say if I had to pinpoint one driver, that would be YouTube.
And Mandeep, there's this phrase that gets thrown around in moments like this. It's right size. They have to right-size the business. And Mandeep, the question we've got to ask is right-size the business for what? For how long? Mandeep, I think Satya Nadella, and you mentioned him of Microsoft, has been pretty open about this lasting more than just a quarter, more than just 12 months. This could go on for a number of years. What kind of timeline are you thinking about? What kind of time frame enters your mind?
Yeah, so look, ad pricing is very tough right now, and we know ads revenue is cyclical. Depending on the duration of this downturn, and no one has a crystal ball here, in terms of how long this is going to be, ad pricing is set by the advertisers. It's a bidding mechanism. It's not software where you get to set your price and, you can raise prices because it's sticky. Ad pricing is all, bidding based, and I don't think it's going to come back until the economy rebounds. So depending on the duration of the downturn, you will see pressure on Google search revenue, YouTube ad revenue, but guess what? I think they still have the kind of the timeshare when it comes to people spending time on their products, and eventually this cyclical rebound will happen. So it's just a matter of controlling costs right now.
The labour force, as you know, at these companies, Mandeep, over the last couple of years have grown almost exponentially. They just exploded. I look at Amazon, went from 800,000 and basically doubled to 1.5, 1.6 million. Mandeep, the question I keep asking, and I'd love your insight on it, are we unwinding the excess of the last 2-3 years, the pandemic years, or some of the excess of the last decade? How do you think about it? 2 or 3, or about 10?
Well, I think there was a massive pull forward in pretty much every sector of tech, whether it was, gig economy, ad side, you name it, software side as well. And we are kind of normalizing for that pull forward right now. Whether it takes, 3 quarters or 6 quarters, I think time will tell. And then you add the interest rate complexity because these are all long duration assets. So you have to, normalize the valuation. But clearly on the top line front, there was a pull forward over the last 2-3 years for pretty much all the tech companies, and now that's why they're seeing slower growth.
Mandeep, just a final one from me. I think a lot of people might reflect on maybe the tech boom, the tech bust. For me, what's original about this moment for these big names, in their current mature form, I can't think of a real cyclical test that they faced, Mandeep, in the United States, because we had this long period of almost undisrupted growth in America. And Mandeep, in a pandemic, that didn't turn out to be a cyclical test for them whatsoever. Is this their first real economic test in their current form, Mandeep?
It is. And given how much they expanded their employee base, remember, all these companies grew their employee base 20% every year. So they really thought that, the growth, 30-40% growth will continue for the foreseeable future. And that's why I think they are right sizing. So I do think digital transformation is a secular trend. It's not going away, and it will come back. And that's where you will see these companies rebound and come out much stronger in terms of their margin structure.
Mandeep, this was great. You're one of the best. And I think I'm going to catch up with you a little bit later around the opening bell. I'm looking forward to it. Mandeep Singh there of Bloomberg Intelligence. Just got to tee up the next ad, Tom, next couple of hours.
That's
on Bloomberg Television.
We're doing the same thing, too.
What are you up to?
I'm up to thinking about David Crosby, and there's a very British angle here.
Talk to me about it.
Very British angle here. I can't say enough about this. I'm not going to do the history walk here now. Everybody will learn about Mr. Crosby, who is younger. The Byrds stunned the Beatles. The Beatles came out of Hamburg in the 50s in a veneration of black music. Andy Leck nails this in Cadillac Records with the Rolling Stones. And over on the West Coast, and David Crosby, frankly, is an LA brat, it was real simple. The Byrds scared them. They went over to England as the Byrds, and they were not greeted too politely by the rock and roll press there. And they wrote a song on the way over that changed music called 8 Miles High. And buried in that is a rain-gray town known for its sound. That's maybe the most famous single line. David, that song, John, 8 Miles High, in the summer of 1966, was the advent to a literal decade of what was called psychedelic music.
A legacy is a word that gets thrown around a lot, Tom.
Yeah.
When you look back at the life of this individual, what will be the legacy, do you think? The number one thing that stands out?
On a music basis, and I with great respect to Stephen Stills and Neil Young and Graham Nash, I would say it was his construction of harmonies. The Eagles came out of what he did with harmonies in the 60s. It was absolutely original at the time.
The legendary US musician David Crosby has died, aged 81.
I think we are very much revisiting the more normal dynamics now.
The Fed probably won't need to be raising rates as much as they are telling us we need to worry about.
Fed does have a responsibility here to try to preserve market functioning.
When we look at recessionary bear markets, and we do think we have a recession this year, they tend to be deep and they tend to be very long.
What scares me is really the pricing in of the soft landing that has happened since the beginning of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television on a Friday, setting up the weekend in the path to February 1st. Lisa Abramowicz I think in transit. Maybe we'll catch her in Davos. Maybe we catch her in Davos here before the helicopter takes her out. But what's important, John, and you nailed this earlier, Vice Chairman Brainerd spoke about the uncertainties, the ambiguities for this weekend as we get to February 1.
2 words: risk management at the Federal Reserve. So when you start to get a little bit more conservative, Tom, you go a little bit more slowly. And that's what they're expected to do, to drop down from 50 to 25. Chair Powell would talk about walking around a dark room. You've got to be careful. And I think they're worried about the balance now between 2 risks, overdoing it and doing too little. And that's become more balanced in the last few months.
I would suggest it's uncharted territory, uncertain territory. They're making it up as they go, and they're data dependent, and they saw some lousy data this week.
Data dependent, sure, dependent on what data. That's what we need to talk about. Jobless claims are 190,000. Unemployment's at 3.5%. Can we continue to see a deceleration in inflation, a softening in wages, without the deterioration in the labour market? So far, so good. Can that continue? And how do you compare what you're seeing in claims with what you're hearing from corporations, large multinationals, Google, Microsoft, Amazon, making big cuts?
Yeah, I agree with that. And it'll be interesting, as Michael McKee said, this claims data, the shock yesterday of good claims, is in the non-farm payroll report that I believe we see February 2nd or 3rd. It's right after the Fed meeting. But John, to your point, I think this is so important, is where are we on the inflation continuum? We've made some headway, but there's still a long way to go. Witness Japan
4%.
in the early with that 4% statistic.
4% CPI. So we've got the BOJ still to come in March. We've got to go to the Fed and the ECB first. Tom, if there was something to worry about in the data, it's a sub-50 ISM, manufacturing and services. And it's kind of odd to see high yield rally in the way it has done to start the year in the face of sub-50 ISMs. That's kind of strange.
I look at it as a disinflationary tendency. You go to the work of, say, David Rosenberg, and you've got in place disinflation, but it's the calculus of it, the rate of change of it to get to Q2 or Q3. And everybody's got a different opinion on that, including John Golub.
This would be hard enough. It's made even more complicated by the fact that China's reopening. And you've seen the rally in EM, the rally in commodities, copper and crude, back through 80 on WTI, the rally in the miners, Rio up aggressively, BHP up aggressively from the October lows, and the deceleration of weakness you've seen in the dollar story as well, Tom. That's all complicating the outlook. I don't know what we look like by the time we get to year end.
Just since the last hour, the 10-year real yield of 1.20, 1.21 is now 1.18%. There's something being said there about inflation, and in the fixed income space, the gyrations of the week. You wonder where we are Monday or Wednesday of next week.
To get you some price action, the 10-year right now, 3.43. Yields higher by 3 or 4 basis points. Yields just a little bit higher this morning across the curve. Outside of that, in the foreign exchange market, euro dollar 108.20, negative 1/10% there, Tom. And futures advanced by 1/3 of 1%. Up 1/3 of 1% on the S&P. And Tom, I've got to squeeze this in. Crude had a little look at 81 earlier, didn't it?
Yes.
$80.88 right now.
$87 on Brent crude. Fadi B-roll, I should say. Most eloquent with IEA and Davos with Francine and Lisa here in the last couple days. This is important. It is that every equity strategist has a certain style. The acclaim of Jonathan Golub at Credit Suisse, either courageous bull or right now with some real reticence, is he dives into sector analysis over on page 5 and page 6 of his reports. He darkens the door this morning. What does the sector analysis tell you right now?
Well, we put out a note this morning on earnings that we're having a margin problem in the vast majority of the sectors, with the exception of, surprisingly, consumer discretionary is better, energy is better, and industrials. But short of that, you're seeing margin contraction everywhere. But if there's a big sector story, it's that tech is really weak compared to everything else, or broadly defined tech. And that's just not something we're used to. The tech is this earnings season, If you take tech out, or tech broadly defined, you have a 5% EPS growth this quarter. I mean, who would think that tech is the thing that's holding everything back? And I think that this continues for longer than we think.
And this is a hallmark of Credit Suisse, is this linkage between strategists and your securities analysis. Do your tech people as a whole feel news-making layoffs can adjust those margins? Can they heal that margin deterioration?
Well, Tom, and we were talking before we went on air about what's going on in terms of layoffs and young people coming into the labor market. A lot of this was an overexuberance when we went into the pandemic and things were so strong for tech demand. The companies hired as if this was a new normal of strength. And what it really is, and this is why tech's having a hard time, it was a pull forward of activity, and everyone believed, the investment community bought into it, the companies bought into it, and now it's unwinding. Companies are laying those workers off. So do we work through this? Yes, but we saw this with Y2K. It doesn't happen in 2 or 3 quarters. It takes a little bit of time to work through.
Okay,
and that's
you've said a few things now. Y2K, pull forward. And you talked about this can go on longer than people think. So let's build on that. How much did we pull forward, one? And what gives you the sense that this can go on a whole lot longer than people think? And when you say that, what kind of duration are you thinking about?
Maybe this ends up being a 6 to 8 quarter period. I mean, just think about this. You bought a laptop because you're now working from home. When are you buying the replacement for that? Not this year. You went and my mother started using a streaming service for the first time. Is she signing up for the second streaming service now if she wasn't doing it before? And it's not, or the move towards global advertising, which has kind of got pulled forward. And so it's not as if the long-term trend is necessarily a negative one, but there was definitely a bit of exuberance as we went into the pandemic, and it just takes a little while. We're also, as an investment community, and if you look at hedge funds in particular, growth in tech has been such a huge win from the time that the iPhone came out in 2008 to now. Everybody staffed up their tech teams. Everybody built processes around it. Nobody wanted to be a value manager. Everyone wanted to be a growth manager. And so it takes a little while for this to kind of
so
play
we're
out.
not used to this, and you've mentioned this. This is not what we're used to. And with that in mind, this is the question of the moment, I think, for a lot of people. How compromised is the index story? Because what we are used to and what we're conditioned by is just sitting in the index on the S&P passively and being very rewarded for it. How compromised is that index story going to be? For how long?
Yeah, I'm not sure it's compromised. I'll tell you. So last night I had dinner with 10 head traders at some of the bigger shops. And I said, if you had a choice between buying the tech basket cap weighted or the tech basket equal weighted, how many would buy the cap weighted?
What did they say?
Not one hand went up. How many would you buy the equal weighted? All 10 hands went up. And so there's a lot of great names. So if you're trading, if you're looking for individual securities, there's a lot of interesting things going on. But these really big cap. Listen, 2-3 years ago, all we were talking about was moats. These are impenetrable businesses.
Secular growth trends.
Yeah, exactly. And listen, and some of these, and they're great. Let's be honest, they're great businesses. But it doesn't mean that they're impenetrable.
So at the dinner last night, which I'm sure you slotted through Credit Suisse Zurich expenses, did you finish as in the old days of Credit Suisse with the Hennessy Paradise brandy? Or did you go a different direction now, like get out a 6-pack of Utica Club?
Yeah. No, we were drinking light beer, and that was so. Yeah, no, it's.
Tell us about this dinner. That's what I want to know.
Well, we do this a fair bit. I mean, next week
it's your job.
Yeah, and if I look at where my ideas come from, so last night was 10 head traders. Next week we're doing 10 guys who are either hedge fund founders or CIOs at some of the
What do
larger
they
shops.
want to know from you? Seriously, I mean, we're making jokes about cognac. Forget about that. What do they want to know from you? What's the mystery for traders and hedge funds tycoons when they talk to John Golub?
If the expectations right now are for weaker, if you look at strategists' forecasts, this may be the weakest year I can remember in terms of forecasts. So the question is, if you can't make money just simply by jumping into the market and riding up a beta trade, how do you play the game? Where's that edge that you get in this environment? Because everyone around the table really struggled last year. Managers had a really hard time, especially hedge funds. So momentum traders have a harder time in this environment. We think there's going to be a big movement last year, the whole story was value. People weren't there. We think that growth snaps back this year.
Oh.
There's a Golub we love
So,
and know.
John, why are you only at 40-50 if you think you get that growth snapback, given the weighting in this index?
Well, there's a couple things. One is that this will be a rare year that earnings are down. Listen, I'm in the non-recessionary camp, and we can talk about that. But I think this is going to be the rare year that earnings are down in a non-recessionary year, and it's because of margins. I mean, take this earnings season. Revenues are up 4.5, margins down 8.5. I don't remember an environment where we saw that much pressure.
So
and
it's Main Street okay, Wall Street bad.
What was that?
Or Wall Street challenged, Main Street okay.
Well, I guess, but I mean, look at what last year was. Wages went up slower than CPI. So companies didn't have to pay higher wages, but they got to move on pricing. That's a beautiful corporate environment. This year, wages are going to be sticky, CPI coming down. They're paying their employees more. They can't pass it on. And so the consumer, the individual is better off this year relative to companies. Last year, it was the opposite. Companies were better off.
I want to talk about that recession call if you can stand it a bit longer. Tom and I just have one question. Can we come to the dinner next week? Can we make that happen? Why are we getting an invite to the dinner? We can host. I can be at one end, Tom can be at the other. We can ask questions.
Well, listen, Lisa has to check her bearishness at the door, though.
Oh, I love
is that?
Did we?
That's she can have the cognac at the end. You just have to check
John,
her bearishness.
This is important. I mean, if you're at a Credit Suisse dinner with Golub, you're getting 100 Oaks de Vie in your cognac, and it's a splendid coppery gold.
Can you give me a price on that?
I don't have a price on it. I can't get there right now. Good morning, Zurich.
John, we're going to force you to stay with us for a few more minutes. Equity futures up 1/3 on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The parent of Google has become the latest tech giant to retrench after years of growth and hiring. Alphabet will cut about 12,000 jobs. That's more than 6% of its workforce. CEO Sundar Pichai says the cuts will affect jobs across the entire company. Pichai says he takes responsibility for the decisions that led Alphabet to this point. The Biden administration is sending another major package of military hardware to Ukraine. It includes 90 Stryker armored personnel carriers, 59 Bradley fighting vehicles, and millions of rounds of ammunition. The package, valued at $2.5 billion. The U.S. and its allies are meeting in Germany today to discuss more aid. Russia is trying to limit a plunge in budget revenue caused by EU sanctions and the price cap on its oil exports. Bloomberg's learned the Kremlin may change the way it calculates taxes on oil. One of the options would add a premium to the current price of Russia's key export blend in Northwest Europe. In Japan, inflation has hit 4% for the first time in more than 4 decades. That's twice the pace targeted by the Bank of Japan, and it's likely to lead to more speculation the central bank will change its monetary policy. And Genesis has become the latest crypto firm to collapse in the wake of the FTX exchange's swift downfall. The cryptocurrency lender filed for Chapter 11 bankruptcy protection in New York. Its top 50 claims amount to about $3.4 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Although we're seeing some signs that inflation is moderating, it remains far too high, and it is my number one concern going into 2023. So with inflation still high and indications of continued supply-demand imbalances, it's clear that monetary policy still has more work to do to bring inflation down to our 2% goal on a sustained basis.
That was John Williams there, the New York Fed president. Some of the top officials at the Federal Reserve trying to get the final word in before the quiet period begins tomorrow. You'll hear from Harker a little bit later and Governor Waller as well. Equity futures right now on the S&P up 1/3% on the S&P 500. In the bond market, yield shaping up as follows on a 10-year. Tom, just a little bit higher, up 5 basis points. Your 10-year this morning, 344.
We are with Jonathan Golub. We're going to continue right now. Global Wall Street giving a nice response with this, the gentleman from Credit Suisse. John, I'm going to go back, and of course we have to use the Dow Jones Industrial Average in honor of Lou Rukeyser. 1974, the bottom, world's coming to an end, sort of like now, sort of like 1788. The Dow 616 to 852, and the next year we enjoyed going from 852 topping out above 1,000. We were up 38% off the gloom of the 73-74 Pittsburgh's going to die recession. Is that where we are right now?
You know what I would love to, I think what every strategist wants to see is that the Fed crashes this thing, we get a really hard recession, you get a V-shaped bounce, and you get a normal cycle. And I think, we were talking about just a moment ago how the strategist expectations for this year are as weak as, as we can see. And I think that the idea of a soft landing is way more likely than people think, but it's not something to get excited about because it also means that you're looking at anemic returns with a lot of volatility.
But if we get a soft landing, does that express out to a 38% up like 1975?
I don't think so. I think that what you're looking at here is the Fed doesn't raise rates enough to crush the. Listen, here's what people are getting wrong on this inflation story. It's the headline CPI is falling, but wages are not falling, services are not falling, and rents are not falling. It's goods that are falling, which means that we're not really addressing the underlying cause of this thing. So the market is getting very exuberant that the Fed is going to pause. They're not pausing because they're stopped. They're pausing because they need more data. They want to slow this down a tiny bit. The street's looking at that wrong. The market sees falling inflation. They're getting really excited about that, but it's goods, and that's a comps issue. It's a one-off thing. It's not that we've gotten rid of inflation. It's we've gotten rid of that component temporarily. And so what I think you're going to see, like last year, a lot of chop without a lot of upward movement. And that's a hard, Tom, you were saying this before, it's a hard investment environment for most people, especially those who are shorter term.
The epicenter, though, of your call is that you think recession is avoidable. You think we will avoid that. What gives you the indication that we will?
The big surprise this year is that if the consumer gets what looks like, let's say, a 5% raise, or for that matter, a retiree gets an 8.1% COLA. So they're getting a lot more money. And we end the year with, 2.5% or 2% inflation, which is roughly what the break-evens are saying or the Bloomberg survey is saying. This will be a great year for consumer purchasing power. Their wages are going up higher than inflation. And in that environment, you've seen now we're 6 months in a row of consumer confidence rising, and we're going to see that all year long this year. And
really?
That's well, just think about it. Jobs are abundant. Your raise is going to be running at 3% above your cost of purchasing things, and that is going to keep us out of this recession. Now, from a profit perspective, companies have to pay those higher wages and don't get pricing power. So you have this weird thing that the consumer's okay, the recession gets pushed off, but corporate profits are really anemic, and investors are shaking their head because they don't know what to do with it.
So pick a sector, discretionary.
Yes.
Where's discretionary in that world?
If you are a company that, like a retailer that has a lot of labor, you're going to have a harder time. If you have a business model that is less labor intense, you do pretty nicely.
I took the Dow math that we were just doing here. In 1975, up 38%. In 1976, up 17%. And that obscures that over a 49-year period without dividends, the Dow or the S&P was up 5.4%. You overlay on dividend reinvestment, I get it. When you go to work or when you have a fancy dinner with 10 fancy people like John Farrow, is it a single-digit return world for you? Or can we get back to 9 or 10 or 11, a small double-digit return?
It's a lower return world. So we're talking about what was the group saying? I surveyed the group. I asked, how many of you have taken some of your equity money personally and moved it towards something that looks like a bond? And the majority of the table said, how do you not? And that doesn't mean they weren't saying I'm panicked about equities. But if you can get, after-tax equivalent of 4.5% on a muni bond, do you put something in? Is that attractive compared to a world where you're looking at negative earnings growth?
Does anybody in the dinner look at the Dow Jones Industrial Average, or do they only look at the Standard & Poor's 500?
Yeah. Only, I don't want to say dinosaur, but there's not a lot of people who talk about the Dow Jones.
Can I have that on the record? Can you actually just say it? Because I'd love that. It's all S&P, TK. You know that. It's all S&P.
I have not any acquaintance with that.
But the S&P story, and I want to finish on this because it is important, has become the dominant story, particularly over the last decade, because it's rewarded investors so handsomely. You mentioned the equal weight. If you had to pick the tech sector right now, would you take it market cap weighted or equal weight? That was a conversation you were having about these investors at these hedge funds. Can you tell me about where you'd leave that story now at the index level on the S&P 500? Would you want a market cap weighted exposure, waiting for the tech snapback that you're looking for? Or would you want something more equal weight? How would you get your exposure?
I don't have a bias against a cap weighted benchmark, but the outlook has to be for at least the next 24 months has to be that an equal weighted benchmark does better. And it's because I think that some of these larger companies, it's harder for them to deliver an above average growth rate given their size in perpetuity. But I think that there are areas that are smaller in the benchmark. Energy, for example, underrepresented in the benchmark, really low PE. If energy does well, the cap weighted benchmark will lag. And so, yeah, you have to go that way.
John, this was great. Love it. What restaurant are we picking? What cuisine? What did you choose? Italian,
he's
French?
picking the
TK.
drinks.
TK's doing the drinks. He'll choose a bar. That's what he always does. Usually at the hotel. It's always a hotel bar. What is it with you in the hotel bar?
They're just really good service as a general rule. They're quiet, and critically, with a lot of the conversations I have, particularly with the wonderful people of Bloomberg LP, I don't want to be sitting next to somebody taking notes from, somebody. I mean, they're just quieter. They're unlike the trashy disco scenes you're going to.
You're saying I go to the disco scene.
You go to they got the ball going around, and they're down on
a disco ball.
River. What's it called?
What decade is that?
You have the thin tie, that whole disco thing. Yeah.
Sure. You think this is disco? What
no, it's not
this is disco?
No, it's Flock of Seagulls about 1979. That tie is back when Tottenham won.
What is wrong with this tie?
There's nothing wrong with that tie. You look like a lad.
You can't throw rocks when you're wearing a bow tie.
You look like a mate.
Don't throw stones when you're wearing a bow tie, Tom.
That's okay.
John, this was great.
You don't have to talk quietly like Jen Bristow talks about.
That's
good.
Like the president.
We'll be back.
That's great. Okay. Coming up, Mohammed Al-Arian of Bloomberg Opinion, of Queen's College as well. Looking forward to that. We'll catch up with Suvajra Rajappa of SocGen.
He talks quietly.
We'll catch up with Suvajra on this bond market and the debt default story of the year. No one thinks it's going to happen. We'll see if it does.
You're
Jared
already
Woodard
selling Ford,
of
your
Bank
show?
of America. Yeah, I'm leaving in a second.
Can I do
and
that
finally,
someday?
here's a conversation on EM you don't want to miss. We'll start on that conversation with Mohammed. Then we'll go to Robert Koenigsberger of Gramercy Funds. Really looking
timely.
forward to that.
Timely.
EM is such a massive theme for so many people this year, Tom, with China reopening. Just huge.
Damien captured this. It's underreported. It's way underreported.
Where do you want to be to leverage that story this year?
Yeah.
How obvious is it? That's going to be the conversation we have, and I'm looking
In the
forward to
debt
it.
dynamics, there's an assumption it's just like us. It's not. There's minimal equity visibility, and the debt dynamic is where the return
And
is.
the real estate piece of it too, which is something you were focused on through much of last year.
Yeah, and domestically, I'm going to focus on real estate this year. I'm really interested to see how commercial real estate U.S. works out.
Going to actually adjust
Huge
here in
mystery.
New York City, lower rents.
Unsure. I
think we're all hoping for that, aren't we?
Yes.
Apart from maybe the landlords.
Maybe catch up with the rest of the country.
Yeah, that would be nice. John, thank you. This was awesome. Thanks for being with us. Equity futures up by
I could trip
a third of
over
1%
trip over the Amazon
on the S&P.
boxes when
I can't believe you've insulted this tie. It's so rude.
I love your tie.
So rude.
I didn't insult your tie.
So rude. We're meant to be friends. Have I ever criticised your bow tie?
Where do you want to begin? Good morning, everyone. Bloomberg Surveillance, a really spectacular week. Major John Ferro, Lisa Abramowicz, and Tom Keene. Shout out to our team, and particularly our booking team, for just giving us wonderful discussions through the day. We continue that. Shonali Basak will be with us here in 15 minutes. And whether you're like me, you really don't care about BitDog or crypto and that world this weekend is blowing up. And Shonali Basak will give us a brief here on a bankruptcy, but much more going on, including the United States Department of Justice. Right now, to have a victory lap. He has appeared in our studios. We're thrilled that Citigroup and Jane Fraser would let him appear. Andrew Hollenhorst with a spectacular call last year on a regime of higher interest rates, and that's where we are. Except at Citigroup, they went from 50 beeps to 0.25%, 25 beeps on the February 1st Derby. So what this is about is Hollenhorst at UCLA learning that one day at UCLA, they actually taught John Maynard Keynes, when the facts change, I change. And Hollenhorst said, what do you do? What did you do yesterday to go from 50 beeps to 25 beeps?
Well, thanks a lot, Tom. Yeah, that's right. When the facts change, you do change. And I think we saw in the data a little bit of softness in the price data. Certainly, we've had softer core CPI readings. And then producer price index usually doesn't get a lot of attention. It definitely got our attention. That was a little bit softer also. It means core PCE inflation is going to be a little bit softer. So I think there's enough softer price and wage data for this Fed to, I think the way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough. I am quite uncomfortable that they've actually done enough here, and I think we're going to see that in some of the upcoming data.
Let's talk about the uncomfortable reality of the x-axis in economics. So you've adjusted for February 1, but the cumulative path out into 2023, does that still give you your high news-making terminal rate?
So we're still at 525 to 550 on the terminal rate. And I would just highlight relative to what I'm hearing Fed officials talk about, relative to what markets are pricing, it would seem to me that that is at the lower end of what would be a reasonable terminal policy rate for this Federal Reserve. So it's very possible, it's our base case that they're getting to this, 5.25 to 5.5% range. But just like your previous guest was talking about, if we see wage growth that picks back up again, and we think it will over the course of this year, if we see service inflation that stays sticky, then we may see this Federal Reserve reassessing, is that really the appropriate policy rate to get to? So although we're hearing Fed officials saying we're going to stay the course, and it maybe makes sense to move at a slower pace now to figure out where that rate is, will we really be seeing the policy response that you need to slow down the economy sufficiently to loosen the labor market to bring down inflation?
I don't know if Willem Bouter, who founded modern Citigroup economics, and on to Catherine Mann and on to you, but I'm going to suggest Professor Bouter studied his A.W. Phillips curve over at LSE a long time ago. Link this to unemployment, and if I get Hollenhorst gloom of a higher rate, what does that do to the unemployment rate and the societal change that will bring?
Yeah, so I think that is something that I think Fed officials need to be really honest about when they talk to the public. The idea that the way monetary policy works is through things like the unemployment rate. It is by slowing down the economy. It is by creating slack in the economy, and is damping demand through those channels. So if you think that this is an economy where demand is outstripping supply, you will need to lean against that with higher policy rates, and that probably will increase the unemployment rate. Now, they have that in their forecast, but they have the unemployment rate coming up to maybe 4.5%. When you're running substantially above target inflation, we still are, even though we've had a few months of softer core inflation, we still are substantially above target. You probably need that unemployment rate to move further than 4.5%. So we're probably going to need to see a 5% plus unemployment rate to bring inflation down. Certainly, can we be hopeful? Could we be hoping that we're going to get a better scenario where the unemployment rate doesn't need to move as high? Certainly, and I think I would hope for that. Everybody would hope for that. But the honest answer to your question, the basic macroeconomics, is that to bring wage growth down, you need to loosen the labor market.
We got to remember, the gentleman from UCLA, Alan Meltzer, wrote a modest 3,000-page history. The only one I know who's read it is Mike McKee. And come on, Andrew, if we societally, coming out of this pandemic, shift from 3.5% up to the Hollenhorst 5%, there is going to be a societal scream about that. Politically, how does the Federal Reserve adapt to that?
Yeah, I think this is one of the reasons that central banks globally and in the U.S. have been made independent, and the idea that they're supposed to operate outside of politics, because politically this is a very difficult thing to do. Now, the education that needs to happen... Is
it happening now with these speeches and the silly micro parlor game that we're doing?
I don't think so. How
do they educate?
So first, be honest. There were large errors in policymaking that led to much too high inflation. We're now recovering from that period of time. And the recovery from that period of time means much tighter monetary policy. So we're in a bad position, right? We should acknowledge that. Now that you're in this bad position, how are you going to get out of it? We could say, let's just accept higher inflation. Right? And this was, in some ways, this is what happened in the 1970s. So we know from that experience that that actually leads to worse, longer-term outcomes. So if we try to pivot too strongly towards worrying about issues regarding growth and unemployment, of course we care about those things, but the bigger risk right now is inflation. And that's why it's been interesting in the Fed speak, right? Because we've heard Fed officials saying, yes, inflation is still the bigger risk. But meanwhile, we see markets that are pricing out future Fed hikes, pricing out more hawkish policy, and Fed officials being relatively accepting of that. And so I think, we're not there yet, but this is kind of the early stages of something that could end up looking like the 1970s, where you essentially declare victory before that victory is really attained.
Well, we got a lot to talk about. We're going to expand this interview out to 3 hours with Andrew Hollenhorst as we dive back to the 70s. I don't want to get you in trouble with the General Counsel of Citigroup or with Ms. Fraser, but I'm going to ask a delicate question. Your giant and one of my heroes, Catherine Mann of MIT, is over holding court at the Bank of England, I would perceive as a hawk. Is there a Catherine Mann at the Fed right now? Is anybody at the Fed a legitimate Catherine Mann hawk?
I think what the Fed is trying to do is be data dependent, and I think that is the right thing to do. You want to watch the data as it comes in. Certainly, if we are going to get inflation and wage growth cooling off, and we can keep the unemployment rate at a 53-year low, that's something that we would love to have happen. And you have to put some probability on these kind of surprising but possible outcomes, right? And the data most recently has been favorable for that type of outcome. So I think that it's not incorrect to be paying the data its due attention. On the other hand, I think what we've heard in the rhetoric, I think Chair Powell has actually been quite on message in terms of talking about resolve in the face of higher inflation. The idea, if you looked at those last minutes from the December FOMC meeting, and they talked about our markets misperceiving our reaction function, our markets thinking that we're more dovish than we are, and they're concerned about that. So you see that level of concern there. You see that kind of hawkishness. I think the issue for Fed officials is that as soon as you get a short period of time, which we've had, a short period of time where the data comes in a little bit more favorably, it's very hard to maintain that messaging, and that's what they're struggling with now.
With time, I got like 8 ways to go here, folks. If you're just joining us on television and radio, Andrew Hollenhorst of Citigroup with one of the great calls of 2022. For this Fed meeting, he shifts 50 beeps down to 25. I heard a little bit of yeah, but there, maybe back to 50, but he maintains this higher interest rate regime, as Dr. El-Arian and Dr. Dudley speak about, is well. I've got to go, I guess because of time, to the glide path and presumption of disinflation. Is it, even if it's curvilinear down to 2%, or dare I say, Olivier Blanchard, 3%, are there kinks along the way? Or is there a good force here to keep disinflation smooth and stable as a trend?
So there are always kinks along the way, and that's important to keep in mind. The softer core CPI prints that we've had, softer core inflation prints that we've had most recently, that has a lot to do with used car prices coming down, goods prices that have slowed more down.
Stuff.
That's chunky good stuff. Those used car prices, we monitor the wholesale prices for used cars, and we've seen those stabilize and now start to go higher, actually. So when we're looking at January core inflation, February core inflation, you won't have that same disinflationary factor from used car prices. What does help you glide down is shelter prices later this year. I think that will cool. We have a lot of evidence that that's going to cool. Non-shelter services, it's a mouthful to say. That is the area we should be concentrated on, because that's where that wage pressure matters. That's where tight labor markets matter.
Take the disinflation dynamic and this non-shelter, which I can't pronounce, okay? Great. Bring that over to an initial claim statistic where you would begin to see evidence of Fed success. I'm going to suggest that number's way more ginormous than a 4-week moving average of 206,000.
Incredibly low initial jobless claims, incredibly high rates of people quitting their jobs, right? And that's important, I think, when we look at some of these headlines about layoffs. If you have layoffs that's showing you that, yes, there's some areas, some sectors where maybe you're getting some loosening in labor markets, but if you have very few people filing for jobless claims, filing for unemployment insurance, if you have people that are very willing, historically willing to quit their job because they feel so good about the labor market, that's saying to me this is still a very, very tight labor market.
You're becoming a pro like Catherine Mann. You didn't answer my damn question. Answer it. What's the initial jobless claims number, Andrew, that equates into a constructive Fed policy? Is it 250? Is it 300?
Yeah, I think you'd expect to see that coming up to something more like 300. You'd see that coming up over time consistently, and we really haven't seen anything like that in the data.
Extraordinary. What are you going to write about this weekend? What are you going to think about this weekend? I'm reading Olivier Blanchard's new book, cover to cover, every footnote. What are you doing?
We are thinking about what this process will be between the tight labor market and wage relationship, and then between that wage and price relationship. And I think those are kind of the big unknowns right now. So it's not hard to believe in very tight labor markets pushing up wages. Is that wage pressure then going to push up prices further? We think so, but margins are also wide, right? So maybe
when you talk to Suvin Horowitz and the other criminals at Citigroup in securities analysis, they telling you these corporations have pricing power?
Especially in the services sector. That's where we still see the pricing power. So goods, maybe not so much, but in services, yes.
This has been great. Andrew Hollenhorst with a clinic there on how you get to a 25 basis point idea for February 1, but decidedly he keeps that high interest rate regime that so many fear out there. Red and green on the screen right now. I'm going to call it a churn in the market. The VIX 20.5 for John and I looking at the yield spaces to say the 2-year yield, could we get to 3.99? Not 4.17 and the 2-year yield. The backstory here into your weekend. Brent crude, $86.52 a barrel. That is decidedly not given way in any way, shape, or form. Dollar fractionally stronger. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Google is joining the list of tech companies drastically scaling back operations. Its parent Alphabet says it will cut about 12,000 jobs. That's 6% of its global workforce. Now, Google has been dealing with a slowdown in digital advertising, plus its cloud computing division still trails Amazon and Microsoft. In Germany today, the U.S. and its allies are meeting to discuss more military assistance for Ukraine. The U.S. has unveiled a new aid package that includes 90 Stryker armored personnel carriers and 59 Bradley fighting vehicles. Meanwhile, pressure is mounting on Germany's Chancellor Olaf Scholz to deliver Leopard main battle tanks. In Peru, police battled protesters who are trying to topple the fragile government of President Dina Boluarte. Now, they're demanding her resignation and asking that new elections be held. Boluarte took office after her predecessor, Pedro Castillo, was impeached. And Bloomberg's learned that Saudi Arabia's sovereign wealth fund considered buying Formula One motor racing. But a potential deal stalled early in the stages last year when its owner, Liberty Media, lost interest in selling. The Saudi fund valued Formula One at well above $20 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We certainly see more demand for, if you like, quality and separate custodianship, and I think that the good providers of that will continue to do well. And I think we will see some more of these principles that you see in other parts of the financial system come to the crypto world.
If I was to trust anyone to analyze crypto, it would be the mathematician and engineer from Edinburgh. Ann Richards is absolutely exquisite. I've done many panels with her at Davos over the years. They're speaking with Bloomberg at the meetings of the World Economic Forum. Right now, and this is really important, and frankly, in terms of news direction, maybe our interview of the morning, Sonali Basak is going to attempt, and I mean attempt, to brief us on the wide set of stories into the weekend on crypto and exchanges, and not even the price of Bitcoin. 21,000 is really not the story. Away from the price of Bitcoin, what is the distinguishing story this weekend?
There's a reason that this Genesis bankruptcy filing is the number one read story coming into the terminal as you wake up this morning. I was up till 1 a.m. reading the bankruptcy filing myself. Remember, this is a company that is tied to the digital currency group Empire, run by Barry Silbert, a well-known name not only in cryptocurrencies, but also on Wall Street at his time as a former investment banker at Houlihan Lokey. So the irony of that now is that a unit of his own empire now going under a bankruptcy process. When you read the reports that are coming out this morning for the bankruptcy process, you see that creditors are at odds. Remember, the number one creditor here is Gemini, the Winklevoss entity, the Gemini Earn entity that halted withdrawals.
Can you predict they could go? I got to be careful in my language. Could the Winklevi go bankrupt?
Well, that's the fight here. They need to get their money back. If they get their money back, that saves them.
I don't want to put you in a
some
compromising
time.
Position there.
But it's a lot of money. It's more than $700 million, and it's more than 300,000 clients of their own that they owe money to.
I tweeted this out yesterday. I'm going to redo it today. This reads like a James Bond movie. This is Karif and Ghosh of Bloomberg, who truly are writing up the dark parts of this story. This is not funny stuff, folks. There's no jokes. I'm going to quote verbatim Sonali. The Financial Crimes Enforcement Network of the Department of the Treasury wrote in an order that, quote, approximately 2/3 of BitSlotto's top receiving and sending counterparties are associated with dark net markets or scams. Ken Rogoff wrote about this in his courageous book, The Curse of Cash. Are we right now where Ken Rogoff was 3 years ago, where now it's becoming about scams, darkness, and crime?
You have to ask yourself, after so much free money, is it only in crypto for one thing? First of all, there's a lot of financial structures created in the last 2 years that a lot of people had a lot of fun with. I think the thing that's important about the case you're talking about is that this is a Hong Kong registered exchange. The founder of that exchange was arrested in Miami. And remember, this is at a time where you have the SEC going after traditional crypto players like Genesis, which is one of the biggest, not only brokerages in the industry, that lending business helps keep that industry alive and heart beating in a big way. BitSlotto, I can't say I've heard of it before the Department of Justice went after it. And the reason it's important for the Department of Justice is you see them expanding their reach when it comes to clamping down on the crypto industry.
I got 8 ways to go here, but on a Friday, Sonali Basak, exhausted from her great coverage of the banks this week. I believe over at Fortress JPMorgan, Jamie Dimon's going to come back from Davos. He's going to put on a hard hat and look at the building, the Palaces building on Park Avenue. And there are people in that building who believe in blockchain, believe in Bitcoin. Their boss is calling it a pet rock, okay? Now we've got criminality involved. How can big bank institutions believe in the pet rock or believe in exchanges that are involved with Department of Justice investigations?
Well, there's a moment here in which a lot of Wall Street, a lot of, the Goldman Sachs, the JPMorgans, the Fidelities, it's a big opportunity for them to use the technology and bring traditional financial rails back onto it. So is this a technology that can change FX markets? Is this a technology that can meaningfully change bond markets? JPMorgan and Apollo will tell you yes. There's another JPMorgan story here. I might as well bring it up while I'm sitting with you, Tom, because I just got off the phone with Mike Mayo a little earlier. Late last night, Jamie Dimon's pay package has come out.
34 million large, right?
Yep, 4.5. It is stable, but interesting part of that. And
so is his tax bill, I might point out. A modest portion of that, folks, goes to taxes, I would suggest.
So I called Mike Mayo. I asked how he felt about Jamie Dimon's pay after not as good of a year. And he said it's easy easier to ask for permission than forgiveness than permission. And that is because more than the pay, JPMorgan has now decided to not allow for the special awards anymore. Remember, they had a special awards package for Jamie Dimon of $50 million or so. And he's saying that, I wasn't happy last year. I didn't think it was fair that any bank CEO gets a bonus on top of a bonus. But now they're saying they'll never do it again. So that's another, new money, old money story.
This is a huge story, and we could go on about this as we can, but is that W-2 pay like mere mortals like you and I have, or is it mostly stock treatment that will be taxed at a lower rate down the road?
It's mostly stock treatment that will be taxed.
Why are we conflating stock-treated assets and the risk of JPMorgan in with his W-2 compensation?
Because I think you have to look at their overall pay at the end of the day. When you look at it, actually Glass Lewis, the shareholder advisory firm, last year gave him a D. I think the year before that, they gave JPMorgan an F. What does Jamie Dimon fail anything at? And so it's interesting to see shareholders for the first time really start to speak up against.
They're saying he's making too much?
Certainly relative to the median worker at JPMorgan. And I think that will...
Yeah, but he's not the median worker at JPMorgan. I mean, I don't think... Matt, where are we on time here? I'm losing track here with Bassick as usual. Oh, we got plenty of time. Folks, stay with us here. I'm going to use the great financial assets screen, and I'm going to look... Hopefully this is going to come up. I can see pre-pandemic, Fortress Diamond has moved operating income from $45 billion out to $60 billion. And I'm not saying he should be paid $157 and take the subway, but did he earn the money?
Well, let me ask you something else. A ton of bankers that are there that are not the CEO of the firm, they're watching their bonuses decrease this year, no matter if it's stock or not. So how do they feel about it when the tippy top pay is quite stable? My colleague at CNBC, Hugh Sun, used to work with us. He had an interesting tweet out earlier this week.
Excuse me, on this show we call Mr. Sun's employer the Dark Star.
Oh,
Hugh Sun is at the
right?
Death Star. The Death Star. Continue.
But he's a friend. And so he had...
and very good.
And very, very good. And he tweeted about how much per employee was being spent on the Goldman layoffs. And it was about $140,000.
This is a severance pay.
Exactly.
Yeah.
And the reason that's interesting, the $140,000, is it's showing you that it's kind of more lower paid workers. It's younger bankers. So it shows you, if you kind of take the two stories put together, that the top end of the pay scale on Wall Street is pretty sticky still. And it shows you that the newer people...
Is that news? It's been that way, I think, back to 1788.
It's news as you're starting to see layoffs. It's news as you're starting to see layoffs and pressure on pay. And remember, wages are sticky. That's certainly true if you're making $35 million.
Yeah, what'd you learn about bank earnings here? It's Friday. We've been able to digest for X number of days here bank earnings. What have you learned?
Everyone's talking about the wealth experiment that has been going on over at Morgan Stanley.
Dead on. Where's it going to be a year from now?
Where is it going to be a year from now? We were talking about the succession experiment. I think it bodes really well for the man who leads that business, Andy Saperstein. You also have something interesting here about the dispersion. People say, okay, the stock on Tuesday, fine. Morgan Stanley flying, Goldman sinking, in the best and worst it has been in years. But let's just take a look at the longer term trajectory, because the market cap of Morgan Stanley at that day jumped $40 billion above Goldman Sachs's. When David Solomon, the day he took over the job at Goldman Sachs, it was worth more than Morgan Stanley. Now there's a more than $40 billion difference.
Well, don't keep us in suspense here. Is Mr. Solomon's employment threatened?
Listen, he's year 5. Every day after year 5 is a test of time. And so the investor day is where all the pressure is.
When is that?
And by the way, his birthday was this week on earnings. That was a fun little fact, a tough day in Davos on an earnings day. But he, February 28th is when the investor day is. Mm-hmm. He's already said, I forgot which analyst, it was the kitchen sink is what this quarter was already called. But is he going to give something to chew on for investors for the next 5 years, the next 1 year?
Do they do that at the Javits Center? No,
at the Goldman Sachs auditorium.
They do it in the auditorium.
Yeah, with a big TV screen.
Sonali Bassick with a very, very busy week here, not only in what we're seeing at Genesis and the bankruptcies and traumas in crypto, but also, of course, what we're seeing in the big bank effort as well. I need to say thank you to our team. I thought the guest quality this week was shockingly good. Just really, really great. Safe travels to our Lisa Abramowicz, I believe by helicopter back to Zurich and on her way here at some point. Red and green on the screen, the VIX 20.59. Both John Ferro and I looking at Brent crude up $87. Coming up, John Ferro with a gentleman from Cambridge. This is Bloomberg.